Okay, let's now move to business valuation. We're done with your mutual funds and mergers. In mergers, an important extension is business valuation discussion. So, one a challenge with this chapter is most of our questions are going to be extremely lengthy. They are kind of very lengthy kind of a question. So, how we are going to take care of it, you will understand. First, I'll focus more on the concept part of it. Guys, please be on mute. I'll focus more on the concept part of it. Once the concept clarity is in place, we'll see some question. Some will solve together, some I'll only solve it. Just to give a broad overview of the chapter, we're first going to start with an approach called economic value added and related areas called market value added. Then we are going to do valuation of a normal company. Valuation of a normal company. For a normal company, we have different models of valuation. Guys, please be on mute. We have different models of valuation. It could be based on cash flows, which is the predominant one, could be based on earnings, could be based on assets. There are three basic ways. One is cash flow, second is earnings, third is on asset, and there's a relative company valuation. So we'll learn about different methods of valuation where you have cash flow, relative, breakup value approach, FMV valuation, net assets. Okay, internal reconstruction, I've added it here. Maybe the notes could be here, but we have already seen the problem when I did mergers and acquisition and restructuring part. Then you will go to a company which is under problem, which is called distress company valuation, which is added in the new syllabus. In the new syllabus, they've added this distress company valuation. You may not have seen this earlier. And valuation of startup. Along with startup, they also have something called as professional or consultancy company and impact of KPI on valuation. There, I may just do some theory kind of a discussion, but it's a broad overview of the chapter. In that, we are going to first start with economic value added. Let me first explain what is economic value added. Every organization uses capital for earning profits for the investor. So whatever capital I employ, what is capital is debt plus equity plus preference put together is called capital employed. So it can be called as fixed assets plus current assets minus current liability, long-term money, long-term money. Whatever long-term money I employ, on that I should at least earn WACC, which is called cost of capital, which is called cost of capital. So what you earn is EBIT. This is what a business earns. This is what a business earns. What it should earn is interest, to pay principal, to pay preference dividend, to pay equity dividend, which is technically WACC, which is technically WACC. So what I should earn is WACC into capital employed. What I earn is EBIT into 1 minus tax rate. Why into 1 minus tax rate? Because WACC is after tax. WACC is after tax. When you do your WACC calculation, you consider after tax cost of debt. So if you are earning extra, it is excess earning which will go to equity shareholder. It is excess earning which will go to, though you are earning for all the three, but ultimately it will go to equity shareholder. And if you are earning less, the impact will be felt on equity shareholder. The impact is going to be felt on equity shareholder. So EVA serves as a key metric for evaluating a company's financial performance. It gauges the company's ability to generate wealth beyond the cost of capital, beyond the cost of capital, often referred to as economic profit. It provides a comprehensive review of the company's genuine economic success. Real indicator of success or failure of the company is through EVA, is through economic value added. Formula is EBIT into 1 minus tax rate minus the invested capital into WACC, minus the invested capital into WACC, or this EBIT into 1 minus tax rate can be called as NOPAT. What is NOPAT? Is net operating profit after tax. Net operating profit after tax. In NOPAT calculation, interest should not be subtracted. Interest should not be subtracted. So net operating profit after tax or EBIT into 1 minus tax rate. This is what the business is earning. What it should earn is invested capital into WACC. Now certain important points. Capital employed means long-term money. Capital employed means long-term money, which is debt plus equity plus preference. In that, equity is what you learnt as net worth. Share capital plus reserves minus fictitious asset. Share capital plus reserves minus fictitious asset. Otherwise, capital employed is nothing but total assets minus the current liability. Minus the current liability. Basically, if you subtract this can also be called as fixed assets plus current assets minus current liability. It can also be called as fixed assets plus working capital. What is working capital? Is current asset minus current liability. So you can keep giving different names to this. You can call it as fixed assets plus working capital. You can call it as fixed assets plus current assets minus current liability. You can call it as total assets minus current liability. When you write your capital employed, assume I had one asset which was purchased 100 years back. Land is there. Accounting tells record this at 1 crore. Accounting tells record this at 1 crore. EVA says no, it's not 1 crore. Today value 100 crore. Please consider 100 crore in calculation. Please consider 100 crore in calculation. So capital employed should be based on economic value of asset. Economic is real value of asset. This would mean that we can go ahead and do revaluation of asset or liability. This can also be called as capital employed on replacement cost basis. In this chapter, predominantly my focus is going to be on MCQ. So MCQ, you'll solve it along with me. MCQ I'll not directly discuss. We will first solve the MCQ so that you get full clarity on the concept. Then when I start doing questions, mostly I may not give you time to solve it. Depending on few questions you may be able to do, but a lot of questions you will not be able to do because they are going to be extremely lengthy kind of question. So let's do first question now. EBIT 25 lakh. This could come as one MCQ in exam. This could come as one exam proper question. Okay, EBIT 25 lakh, tax rate 40%, invested capital 50 lakh, WACC 12%. How much is the economic value added? You can write along with me. You will write, not no only calculator. We are going to solve these MCQs. This chapter major practice is going to come only from the MCQ part of it. Solving part will be there, but that will be on the lesser side. Let's start. EVA is equal to EBIT into 1 minus tax rate, EBIT into 1 minus tax rate. You can open the concept book and keep it because the focus is going to be on concept book for a good amount of time. Around 1.5 hours will go in concept book itself. Then only I'll get into the problem solving part of it. EBIT into 1 minus tax rate minus capital employed into WACC. Capital employed into WACC. EBIT into 1 minus tax rate minus capital employed into WACC. What's the EBIT given? Into tax rate. In the exam, if tax rate is not there, you can take an assumption if you wish to, or you can ignore if you wish to. That's your wish. What's the capital employed? 50 lakhs. WACC 12%. Get the EVA. A very simple, straightforward calculation. EVA is 9 lakhs. Any doubts on this? Yep. Can you proceed? Any doubts on EVA of 9 lakhs? Next, second example. Fragrance Limited has reported a NOPAT to capital employed as 2.5% plus WACC for the year ending 31st March 2021. EVA is 4 crores. How much is the NOPAT if WACC is 7.5%? This is some reverse working kind of a calculation. This is some reverse working kind of a calculation. Here they are saying NOPAT divided by capital employed. NOPAT divided by capital employed is 2.5% plus WACC. 2.5% plus WACC. EVA is 4 crores. So understand this now, right? EVA is equal to NOPAT minus capital employed into WACC. EVA is equal to NOPAT minus capital employed into WACC. How much is the EVA? 4 crore. NOPAT is 2.5% more than the WACC. NOPAT is 2.5% more than the WACC. So NOPAT is, what is the WACC? I technically don't even need the WACC number. I don't need, that will help me in calculating NOPAT. But as such, even without WACC figure, I can calculate capital employed I want. So NOPAT is 10% of capital employed. 10% of capital employed, and this is 7.5% of capital employed. This is 7.5% of capital employed. WACC into capital employed. WACC into capital employed is 7.5% into CE. What is the CE number? No. 160 crores. 160 crores. EVA is NOPAT minus capital employed into WACC. 4 crore is equal to 10% of capital employed minus 7.5% of capital employed. So my capital employed is 160 crores. My capital employed is 160 crores. What is NOPAT now? 10% of this, which is 16 crore. To cut it short, my EVA is 2.5% of capital employed. Why EVA 2.5? That is the extra generation. What is EVA is? Extra in addition to the WACC. Extra in addition to the WACC. WACC is how much? 7.5%. Extra how much you are generating? 2.5%. So that extra is technically EVA. Any doubts in this? Clear? This came a 6-mark exam question. I'll show you the question. It did come in exam, and as usual, because it was something like a new question, student ended up struggling in exam. This was the question. Fragrance Limited has reported an OPAT to capital employed of 2.5% plus WACC. EVA is 4 crore. You are required to compute the amount of capital employed. NOPAT if WACC is 10%. I've just changed the numbers here and there, but this is the question. This was an exam question. And once you get full clarity on the concept, I need not discuss this question. I'm kind of done with this problem. Any doubts on the concept? Okay. Book value of asset is 2000 lakh.
Sir,
Sorry, yeah.
how did we get the NOPAT at 10%?
7.5% plus 2.5%. WACC. Okay. Book value of asset 2000 lakh. Replacement cost of asset 6000 lakh. What is the capital employed for the purpose of EVA computation? I just want this alone because this was tested in one of the question. So what is the capital employed you want me to take in this? Should I take 2000, 6000 average of this? 6000, because we go by economic value, real value. So 6000 lakh. You'll have to take 6000 lakh. Clear? Any doubts on this? Next, EBIT is 2000, tax rate is 40%, capital employed is 8000, WACC is 10%. How much is EVA? Quickly give me the answer. I don't have anything to do here. Maybe the concept got repeated, I think here. 2000 into 1 minus tax rate minus 8000 into 10%. 2000 into 1 minus tax rate minus 8000 into 10%. You are getting answer is 400. Any doubts till this? Okay, we have learned normal EVA calculation. Now comes the EVA adjustment. What EVA is saying is we have to go with real profit of the company. Real profit of the company. So it is saying I will adjust certain items. What item? One example, advertising. The benefit of advertising will be there for 3 years, 4 years, 5 years, 2 years. So it says please add back advertising. Please add back advertising and write off only the real value which is there for a year. Only for a year. So some deferred revenue expenditure we have to add back to the EBIT and write off something called as amortization on this. According to this concept, advertising, training is an asset. Advertising is an asset, training is an asset, research and development is an asset. So you please add back these assets, and on these assets what you should do? You should charge depreciation. You should charge depreciation every year. Second, in your accounting you charge company's account depreciation. In income tax you add back and then do your income tax. Same thing they are saying, you will have accounting depreciation, eliminate that. Go with economic depreciation. What is economic depreciation? Based on economic value of asset. Based on economic value of asset. You want to revalue a building, please add extra depreciation. Please add extra depreciation on top of it. So certain adjustment. First is advertising, R&D, research, everything. Your EBIT increase current year profit and deduct economic depreciation. Just because profit is going up, capital employed will also go up. Capital employed will also go up, because what is capital employed? Fixed assets plus current assets minus current liability. So if you add back, automatically your equity value will go up. Reserves will go up. Automatically this will show improvement in capital employed. Depreciation, add back accounting depreciation, deduct economic depreciation. Whatever is the difference in the value, that will impact in capital employed also. Non-cash expenses. An example of non-cash expenses, provision for bad and doubtful debt, which is not a real expense according to this concept. So if you have such an items, please add back. Non-cash does not mean depreciation here. It's in the other than depreciation, where you are just charging in your books of accounts provision for bad and doubtful debt. Add back that item. Add back that item. Tax charge. This is alone very tricky, because what happens in tax is, in your accounting you charge income tax, you charge deferred tax, all that. What it says is, whatever you charged in your books of accounts, please add it back and deduct something called as actual taxes paid, cash taxes, actual taxes paid. There is going to be one adjustment on this. I'll explain as we proceed. Let's see certain example. Company reported EBIT of 2000 lakh. The same has been after writing of training expense of 500 lakh. The benefit of training will be there for how many years? 5 years. What is the adjusted EBIT? What is the adjusted EBIT? Now, right, adjusted EBIT is equal to, how much is the reported EBIT? Add back 500. Add back 500, because this is be added back. This is not to be deducted. What will you deduct? How many years is the benefit? So 500 by 5. 500 by 5. Add back 500 and deduct 500 by 5. What do you get? When you do your EVA calculation, start with 2400. For EVA calculation, 2400 is the starting part. Format for computation of WACC, because you will need WACC calculation. This you could have learnt at CA Inter. Source, cost, weight and product. There will be a cost of debt. There will be a cost of equity. There will be a weight. Sum of product by sum of weights will give you WACC. Sum of product by sum of weights will give you WACC. These are subcomponents of EVA calculation. When I combine all these concepts together, you will see an exam question. When I combine all the concepts together, you will see an exam question. So here WACC will be calculated in this way. First thing, you have to use after tax cost of debt. You have to use after tax cost of debt. So if you have pre-tax cost of debt, convert that into after tax cost of debt. How will you convert? Pre-tax into 1 minus tax rate. Cost of debt is to be taken as post-tax cost of debt. The same can be calculated as interest rate into 1 minus tax rate. Alternatively, you can do interest into 1 minus tax rate, interest amount into 1 minus tax divided by the value of debt. Few question, what will happen is, they will give you something like this. Take this example itself. Instead of using this word pre-tax, they'll just say cost of debt. They'll just say cost of debt. Now you don't know whether it is pre-tax or post-tax. So an assumption is needed. Before I take an assumption, I'll just do one small check. What is that check is? How much is the debt here? 150. 12% they have said. 150 into 12% is how much? 18. I see interest is 15. I see interest is 15. 150 into 12% is 18. I will try to do some comparison to understand whether that 12% is pre-tax or post-tax. For example, you exactly see 18 here. You exactly see 18 here. Then you can understand that 12% is before tax. That 12% is before tax. Assume you do the calculation and you get the figure as 4 lakh or 5 lakh. Then that 12% could be after tax. That 12% could be after tax. Your after tax cost will be lesser than your pre-tax cost. This is just to check before making an assumption, because problem is silent. I'll have to make assumption only, but I can just do a small check. I can just do a small check, that is amount of debt multiply with the cost of debt given should be equal to the interest in the financial statement. If it is equal, it means it is before tax. It means it is before tax. If there is a huge disparity, it can be before tax, it can be after tax. Make assumption and proceed. But before making assumption, I just want you to do this calculation. Cost of debt given in question can be taken as pre-tax or post-tax depending on assumption. We should do one check before making assumption. We need to compute interest by debt. In that example, interest was some 15 rupees, debt is there, and compare the same with the cost of debt given in question. I can do this way also, that is interest divided by the debt, and compare this. If you calculated number is closer to the cost of debt given in the question, then it means it is pre-tax, otherwise it is post-tax. Now let's do WACC calculation. The switch on the AC. Pre-tax cost of debt 12%, cost of equity 16%, debt by asset ratio 0.4. Compute WACC. Compute WACC. Let's start. Source cost weight product. Source cost weight product. You'll understand the difference. Source cost weight product. Computation of WACC. Debt equity overall. Debt equity overall. Do it along with me. You'll understand the differences. What the cost of debt given? 12%. Very clearly mention what? Pre-tax. I want post-tax. I want post-tax. So 12 into 1 minus tax rate. Cost of equity. Then they've said debt by asset. What is debt by asset? Is debt is 0.4. Asset is 1. Equity is balance. Equity is balance. So debt is 0.4. Equity is 0.6. Overall is 1. Overall is 1. This will give you WACC. You will understand the difference once I do the next example. 13.2 sum of product by sum of weights. Sum of product by sum of weights. Clear? Any doubts on this? The moment I discuss the next example, pre-tax cost of debt 12, cost of equity 16. We are not going to do, you just listen. Debt by equity. Debt by equity. So equity is 1. Debt is 0.4. Equity denominator is 1. Equity denominator is 1. Total is 1.4. Total is 1.4. Sum of product by sum of weights. Sum of product by sum of weights. Understand the difference between debt by asset. Debt by asset means debt is 0.4. Equity is 0.6. Debt by equity. Debt is 0.4. Equity is 1. Equity is 1. And this leads to 14% answer. This leads to 14% answer. Any doubts on this? Any doubts? Understood the difference? Debt by asset and debt by equity. Let's do the next example. Company has share capital of 100 lakh, debt of 200 lakh. Company has a patent of 100 lakh which is not recorded in books. Cost of debt is 8%. Cost of equity is 14%. How much is WACC? Let's put it in our format. Source cost weight product. Source cost weight product. How much is the cost of debt? Cost of debt. Cost of debt. 8%. Cost of equity. How much is the amount of debt? Any asset not recorded in books of accounts or any adjustment you do, only equity value will go up or equity value will go down, because any adjustment will only impact the net worth of the company or the reserves of the company. What is the equity value today? 100. This 100 will go up by another 100. This 100 will go up by another 100 because you're going to record patent in the books of accounts. You're going to record patent in the books of accounts. So 100 will become 200. 100 will become 200, and now you do the calculation. Answer is 11%, because patent which was not recorded in books of accounts will go and impact the equity value, will go and impact the equity value. Clear? Any doubts on this? Any doubts on this? Done? Operating income, net income. These two words we may be using at few places. Operating income means EBIT. Operating income means EBIT. Net income means profit after tax. Net income means profit after tax. Operating income is EBIT. Net income is profit after tax. Clear? Any doubts on this? Next comes EVA dividend. What is EVA dividend? Is any organization when it earns any economic value added, it means that is extra profits for the company. Who will enjoy the EVA? Equity shareholder. So concept says if you have earned any EVA, you can give extra dividend to your equity shareholder. You can give extra dividend to your equity shareholder. So whatever is EVA divide by number of shares is called EVA dividend per share. It's called EVA dividend per share. Normally when you declare dividend, share price has to fall. Share price has to fall, but this is extra. You can give it to them. In case you decide not to give, then your value will go up. Then your value will go up by the amount of EVA dividend per share because you decided not to give it to the shareholder. You're retaining in the company. You're retaining in the company. EVA dividend is extra earning of the company. Extra earning of the company. Concept says give it to your shareholder. Concept says give it to your shareholder. You are saying no, no, I don't want to give. I don't want to give. If you give, no impact on value. If you don't give, value will go. Value will go. EVA is excess generation. Same can be paid to equity shareholder without any impact on company valuation. If the company does not pay EVA dividend, value will go up by the amount of EVA. Value will go up by the amount of EVA because EVA is excess generation. EVA is value of the company. Value of the company is value of debt plus value of equity. So value of equity will go up, automatically value of firm will go up.
Sir, sir, one doubt, sir. Written before directing, how is it only attributable to
WACC into capital employed is taking care of interest, equity dividend, preference dividend, everything is taken care in that. So I've subtracted that. After that, leftover money. After that, leftover money. That leftover money obviously has to go to only one person who is equity guy. Someone had a doubt in live online, please let me know.
Sir, generally, if you pay dividend, the value of the shares will go down, right?
Right.
But in this case,
because this is
you're saying that
this is extra generation. So if you pay also, it's not a problem. If you don't pay, value will go up because EVA is extra generation.
Okay. Done.
Company has reported EV of 20 lakh. There are 5 lakh equity share. How much the company can declare as dividend per share before the value of the company would start to decrease? That is till that point, no problem. Till that point, no problem. How much is the EVA? 20 lakh. Number of shares? 5 lakh. So you can declare 4 rupees dividend. You can declare. If you go beyond 4 rupees, value will start going down. Value will start going down because this is extra generation. This is extra generation.
So anything above 20 lakh can be
anything? Yeah, there's extra. If you pay, it is gone.
obviously.
Computation of EBIT using financial leverage. What is EBIT using financial leverage? This formula of financial leverage you would have learnt at CA Inter. ICA ended up asking this in one of the question. They ended up asking this in one of the questions. So what they did smartly is instead of giving EBIT figure, they gave financial leverage figure and told you to calculate EBIT. Told you to calculate EBIT. So this is just again I'm writing that formula. Let's see this here. Financial leverage 3 times. Company has 11% debenture of 400 lakh. How much is the EBIT of the company? This would have looked very simple at CA Inter. This would have looked very simple at CA Inter. Now also it could be simple, but you could have forgotten it. You could have forgotten it. Now write FL is equal to EBIT divided by EBT. EBIT divided by EBT. Preference dividend error is not there. 3 equal to EBIT. Let's call EBIT as X. X. EBT is EBIT minus interest. EBT is EBIT minus interest. How much is the interest expense? Denominator is X minus 44. Denominator is X minus 44. Calculate X, that is the EBIT. Denominator is X minus 44. So it is not a very tricky thing and all. The issue is you would have forgotten what you did at CA Inter in financial leverage, and suddenly in an exam such question comes, you start struggling with it. Any doubts on this? Okay, this is the most important part. Tax adjustment on EVA computation. Most important part. Lot of times ICI adjustments or ICI does some wrong adjustments and all. Let me first explain. Concept says you should subtract only cash tax. You should subtract only cash tax. What is cash taxes? Taxes actually paid by the organization. Now, when you calculate your NOPAT, you don't subtract interest. You don't subtract interest. But unfortunately or fortunately, interest has a tax benefit. Interest has a tax benefit. So, your actual income tax paid is normally lesser because of the tax benefit on interest. Because of the tax benefit on interest. But concept says you should not consider interest in your calculation. Similarly, you should not consider tax benefit on interest also. You should not consider tax benefit on interest. Now, what I'm trying to say, EBIT is, let's assume 100. Interest is 20. EBT is 80. Actual tax paid is 24. EAT is 56. Now, our concept will say subtract 24 only. Concept is going to say subtract 24 because that's the actual tax paid. But there's a problem with that 24. If interest was not there, it would have been 100, 0, 100, 30, 70. This is the right NOPAT. Right NOPAT is 70. Right NOPAT is 70. Now, how do I come to right NOPAT? First option, 100 into 1 minus tax rate. 100 into 1 minus tax rate. Second option, start with EBIT which is 100. Start with EBIT which is 100. Deduct income tax which is 24 and deduct extra income tax on that interest also. Deduct extra income tax on interest also. That is 100 minus 24 minus 20 into 30%, 6. 20 into 30%, which is 6. First option is EBIT into 1 minus tax rate. 100 into 1 minus tax rate. Second option is do 100 minus what taxes you paid. That is right. But taxes paid number is wrong. Taxes paid number is wrong. Why is it wrong? Because taxes paid, income tax guys are allowing interest. Income tax guys are allowing interest. So if interest is not subtracted, please don't give this in your calculation. Please don't give this in your calculation. So you subtract that also. Third option, start with PAT, which is 56 and add back something called as interest net of tax. Add back something called as interest net of tax. 56 plus 20 into 1 minus tax rate. 20 into 1 minus tax rate. All the three will give you 70 provided question doesn't do any goof up in the numbers. If there are problems in number, I cannot help it. Three options is there. EBIT into 1 minus tax rate. Second option, EBIT minus tax actually paid minus the tax foregone on interest. Tax foregone on interest. Third option is PAT, add back interest net of tax. Add back interest net of tax. Clear? Any doubts on this? Any doubts on this? Next, P multiple. As I have told, P multiple can be taken as inverse of cost of equity. The P multiple can become inverse of cost of equity. So, P multiple basically measures the risk of a company. P multiple basically measures the risk of a company. TCS, Infosys, same business. TCS, Infosys, same business. If you are in the same business, every business has two type of risk. One is called operating risk. Second is called financial risk. Like you had operating synergy and financial synergy. Operating risk is dependent on the business of the company. So operating risk of TCS and Infosys should be almost similar. Financial risk is dependent on capital structure. What is capital structure? Is debt equity mix. So if operating risk is same, my company has huge borrowing. Your company doesn't have huge borrowing. If I have huge borrowing, it means I'm more risky. And if I'm more risky, I'll get a lower P multiple. You do not have huge borrowing. So you are considered to be less risky. If you are considered to be less risky, market will start giving you better P multiple. It will start giving you higher P multiple. Example, company A has debt by assets of 0.8. Company B has debt by assets of 0.2. Nothing much for you to write. Somewhere when things are to be written, I keep telling you, both companies are identical except for capital structure. Industry P multiple is 15 times. Ideally, same 15 can be copied. But what should be the likely P multiple of company A? And it's not P, sorry, it is B. Company B. Which is more risky? A is more risky or B is more risky? A is more risky. If you are more risky, lower P multiple. If you are more risky, lower risk comes from two places. One place is operating risk, which is identical, Second is financial risk, which is capital structure. The P multiple for companies within the same industry is typically expected to align closely with the industry's average. However, adjustment can be made for the varying level of risks associated. Companies with higher risk profile tend to exhibit lower P multiple. If you carry more risk, market will not give you better P multiple. And if you have low risk, market will give you higher P multiple. Company A carries more risk, company B carries less risk. His P multiple of B will be higher than the P multiple of A. Any doubts on this? Okay, this is valuation of firm on the basis of EVA. Now, what is valuation of firm on the basis of EVA? EVA basically means excess generation. EVA basically means excess generation. How much extra did I generate? How much extra did I generate? So, what concept says is value of a company is equal to capital employed, which is today's capital employed, debt plus equity plus preference all put together, plus any excess EVA which is going to be generated in future. So they are saying current capital is how much? 80 lakh. If you are not generating any EVA, market will also give 80 lakh only. Market will also give 80 lakh. Then you are saying present value of future EVA. First year EVA, second year EVA, third year EVA. You will keep generating EVA in future. Extra how much? 1 crore 20 lakh. So market will say 80 plus 120. I give you value of 200. I give value of 200. How did I get present value of future EVA? You'll have to calculate the EVA for future years and then do discounting. Year cash flow PVF DCF, year EVA PVF and DCF. You'll have to estimate the future EVA and then do the discounting. Any doubts on this? EVA is a P&L item. EVA is a P&L item. MVA is a balance sheet item. MVA is a balance sheet item. Now, what is EVA and MVA difference? EVA basically says how much extra are you generating every year. If you keep generating extra every year, you will have MVA, market value added. What is market value added? Is difference between market value of firm and book value of firm. What is book value of firm? Debt, equity and preference. You see many companies in the practical world, the market capitalization is 15 crore 15 lakh 24 crore 15 lakh 24,554 crore. Its book value, the net worth will be very less. The net worth is around only 1 lakh crore. Net worth is 1 lakh crore, but market is giving 15 lakh crore. The difference is market value added. The difference is market value added. Why is this market value added coming? Because you are generating extra every year. You are generating extra every year. So book value of firm, which is share capital plus reserves and surplus plus preference plus debenture, all that. Market value of firm is market value of equity plus market value of debt plus market value of preference. If no data is there, book value of debt, market value of debt is same. Book value of preference, market value of preference is same. But market value of equity and book value of equity will not be same. An example, market value of equity is 10,000. Book value of equity is 4,000. Book value of debt is 2,000. How much is the market value added? How much is the market value added? Now write. Market value of firm is equal to market value of firm is equal to market value of debt plus market value of equity. Market value of debt plus market value of equity. Market value of firm is equal to market value of debt plus market value of equity. In this example, is there a market value of debt? Same as book value. If nothing there, same as book value, which is how much? 2,000. Is there a market value of equity? How much? So this is what market is giving us value. Why market value of firm is debt plus equity plus preferences? According to financial management, owner does not mean only equity, guys. Owner means debt, equity and preference. All the three people are owners of the company. All the three are owners of the company. Then book value of firm. BV of debt plus BV of equity. What's the book value of debt? 2,000. Book value of equity? Difference is the market value added. Difference is the market value added. Okay. Equity share capital 10 lakh. Reserves and surplus 40 lakh. Share is quoted in the market at 80. How much is the market value added? How much is the market value added? There is no data on debt and preference and all. Only equity is there. Doesn't really matter. Market value of firm is equal to 1 lakh into what? 80, which is 80 lakh. 1 lakh into 80, 80 lakh. Book value of firm is equal to share capital plus reserves plus debt plus preference minus fictitious asset, anything there, 50 lakh. The difference is how much? 30 lakh, which is the market value added, which is the market value added. Do the next example. How much? Your number of shares is how much? 20. 20 into 50 is the market value. 20 into 50 is the market value, which is 1000. Book value is 200 plus 400, which is 600. In both, you can add the debt amount. In both, you can add the debt amount. The gap is 400. The gap is 400. Any doubts on this? Okay. First, broad understanding on valuation. Okay. Valuation can be of three forms. One based on cash flow, second based on earnings of the company, third based on assets of the company, and then another the approach which is coming into picture is something called as relative valuation. What is relative valuation? Is valuation on a basis of a proxy company. I want to value Bharadwaj Institute. Find any educational services company and based on them do the valuation of our entity. So we have three, four approaches of valuation. In that, in cash flow, we have two types of cash flow: free cash flow to firm, free cash flow to equity shareholder. FCFF means the cash flow applicable to the owners of the company. FCFE means the cash flow applicable to the owners. Both are owners only, but the term owner is different. FCFF says owner means equity shareholder, debt holder, preference shareholder. All the three are owner. FCFE says only equity shareholder is the owner. FCFE says only equity shareholder is the owner. Now, what is the difference? The difference is very simple. If the term owner is changing between the two approaches, the term owner is changing, any cash flow between the owner and the company should not be recorded. If you say your owner is equity, debt, preference, ignore equity dividend, ignore preference dividend, ignore buyback of shares, ignore new shares issued, ignore loans repaid, ignore interest paid. Any cash flow between the owner and the company is to be ignored. Any cash flow between the owner and the company is to be ignored. Who is owner, who is company? You will have to be very clear. Who is owner, who is company? Owner for FCFF means equity, debt, and preference. Simple thing you need to know: any cash flow between company, which is one side of the pocket, and the owner, which is the other side of the pocket. Please, one pocket, another pocket, you keep shifting. All that should not come in your cash flow calculation. So you keep transferring money from here to there to here. We are not bothered about all of that. So if I am giving something to equity shareholder, don't write in cash flow. He is giving something to you, don't write in cash flow. You are giving something to debt holder, don't write in cash flow. He is giving something to you, don't write in cash flow. That is what FCFF says. That is what FCFF says. What does FCFE says? Any cash flow between owner and the company. Who is owner? Only equity shareholder. Only. So in FCFE approach, interest will be subtracted, repayment of loan will be subtracted. New loans taken will be in fact written as inflow. New loans taken will be in fact written as inflow because that will improve my cash flow. That will improve my cash flow. So FCFF, you use discount rate WACC. You use discount rate WACC. It will give you value of firm. It will give value of firm, which is useful for both equity shareholder and debt holder. FCFE, you will discount at cost of equity. You will discount at cost of equity. You'll get value of equity. This is only for equity shareholder. Ideally, whether you use FCFF or you use FCFE, final answer should remain same. That is, FCFF will give you value of firm. From there, if you subtract debt, you will get value of equity. And you directly do FCFE, you will get value of equity. None of the ICA question has data properly. So first preference is FCFF approach. FCFF approach, get value of firm, subtract value of debt, get value of equity. Subtract value of debt and get value of equity. If data is given properly in the question, I have no headache. But many a times data will have a lot of challenges because you have to go back to the previous data, all that, and then do the proper numbering. ICA will not do it. So if you do FCFE and get value of equity, and if you do FCFF and get value of firm and deduct debt, both answer may not match. Both answer may not match in exams. May not match in exams. So our preferred approaches go with FCFF. Go with FCFF. Get the value of firm. Subtract the amount of debt preference, whatever you want to subtract. And as I said, if cash flow that a firm generates available to all its capital provider, in this case you will have to subtract interest on debt, repayment of loan. All this needs to be subtracted. All this needs to be subtracted. There are multiple ways of calculating. I'm not even getting into this. Let's see this later. Let's look at these numbers now. Let's look at this example. EBIT of year 1 200, interest of year 1 40, tax rate 30%, depreciation of year 1 20 lakh, capital expenditure of year 1 40, year 2 50, decrease in working capital in year 1 is 20, capital expenditures incurred at the start of the year. How much is the FCFF of year 1? We'll just try to calculate FCFF, free cash flow to firm. Let's start. Computation of FCFF. Once you understand the MCQs, that itself is sufficient. Computation of FCFF. Was the starting part? EBIT is how much? 200 less interest. I've written only for your understanding, not applicable. Interest is not applicable. I need not even write this, okay? I need not even write this. Technically, EBIT or EBT is same in this approach. EBIT or EBT is same. What is the tax rate? On 200. On 200. EAT 140. EAT 140. Add back depreciation. Add back depreciation. How much is the depreciation? This depreciation would have been subtracted in EBIT calculation. Would have got subtracted in the EBIT calculation. Less capital expenditure. Now listen. FM basically always says cash flow should happen at the end of the year, but here it's happening at the start of the year. So capital expenditure will be, it is like this. Year 1 is start of year 1, which is technically called year 0. Start of year 1 is technically called year 0, and start of year 2 is technically called end of year 1. So capital expenditure for first year is 50 lakh. Capital expenditure for first year is 50 lakh from a cash flow point of view. From a cash flow point of view. Even for depreciation also, it is in the first year, because next year when you acquire this asset, you will charge depreciation for the full year. You will charge depreciation for the full year. So capital expenditure minus 50. Minus 50. There is some working capital, what they mentioned. Listen, any asset increase is an outflow. Any asset increase is an outflow. Capital expenditure is fixed asset increase, outflow. Working capital increase is net current asset increase, outflow. But if working capital decreases, funds get released. Working capital decreases, funds get released, and it is inflow of money. Working capital decreases, inflow of money. Inflow of money. Any working capital, see, basic thing is, I don't want my assets to increase. If any asset is increasing, it means you have used cash to increase it. It means you have used cash to increase it. So any increase in asset is outflow, excluding cash, obviously, excluding cash. And any decrease in asset, working capital is an asset only. Working capital is an asset because it's current asset minus current liability. So add decrease in working capital. How much? No, decrease in working capital. 20 CFF. Excellent question. Just the concept gets tested. If you are very clear on this, I'll keep doing this for lengthier question, because in valuation, lengthier question, you'll only be in lesson mode. You'll not be able to do it along with me, because most of the questions will involve a lot of lengthy calculations. Any doubts on the FCFF number? Clear? Can we proceed? Any doubts on this? Let's do the next example. A Limited plans to acquire B Limited. Both are in the same industry. B Limited earned a profit of 13 lakh in last year and had depreciation of 6 lakh. B Limited is no longer required to maintain its own production facility. Hence, it can be assumed that only a minimal amount of cash will have to be reinvested to keep its equipment current and for future growth. This amount is estimated as 1 lakh per year. Can you tell me what does this 1 lakh mean? What does this 1 lakh mean? Capital expenditure. That is technically the capital expenditure. Acquisition has synergy gain of 6 lakh. Acquisition has synergy gain of 6 lakh. What is the annual cash flow by A Limited from B Limited if the acquisition is made? If the acquisition is made. Let's start with same thing. PAT. Here we will start with PAT. We will start with PAT. Read and tell me what will be the PAT. Read carefully. Read carefully. It is not 13.
19 lakhs.
Yeah, it is 19 lakh because there is a synergy gain. Last point. There is a synergy gain. So PAT is going to increase from 13 lakh to 19 lakh. PAT is going to increase from 13 to 19. Add depreciation. How much is the depreciation? 6 lakh. Deduct capex 1 CFF. FCFF is 24. Any doubts on this? Yep. Can you proceed? EPS 10 rupees. EPS 10 rupees. Capital expenditure 5. Depreciation 4. Working capital 4. Debt ratio 30%. How much is FCFF per share? Now write. FCFF is equal to EPS minus equity. Sorry, not this way. Sorry. Let's directly do. Sorry. Particulars and amount. EPS is how much? Then add depreciation less capex. How much? Less working capital increase. CFF. I'll explain what is the debt ratio. Just give me a minute. Your FCFF is 5 per share. What does debt ratio mean? How much ever extra you want, something is going to come from debt, something is going to come from equity. Least bother about it. I'm least bothered about it because FCFF does not consider debt repayment, does not consider new debt taken, does not consider equity taken, does not consider equity buyback. So I'm least bothered about when I do FCFF. Same question I can do FCFE. I'll explain FCFE for your understanding. EPS is 10. Now, in my company, there's a capital expenditure of 5, there's a depreciation of 4, and there's a working capital of 4. Indirectly, my assets will increase. My assets will increase by 4, decrease by 5, increase by 4. Assets will net increase by 3. Assets will net increase by 3. What is net asset increases? There's a capital expenditure of 5. Sorry, I've written the other way. Okay. Capital expenditure is 5, which is going to be the increase in fixed asset. Depreciation is 4, which is the decrease in fixed asset. And working capital is 4. Net your fixed asset will increase by 5. In this 5, some money will be brought by debt, guys. Some money will be brought by equity, guys. Whatever debt guys are bringing in, and whatever equity guys are bringing in, you will have to do that calculation and accordingly estimate FCFE. Just give me a minute. I don't know why I'm. Okay. So there are two, three approaches. FCFF was how much? FCFF was 5. Your capex net of working cap, sorry, capex plus working capital minus depreciation is 5. Two people are going to bring in debt, equity. Debt guys is going to bring in 30%. Equity guys is going to bring in 70%. Debt guys is going to bring in 30%. Equity guys is going to bring in 70%. So 1 rupee 50 paise will come from here. 3 rupees 50 paise will come from here. 1 rupee 50 paise from one side. 3 rupees 50 paise from the other side. What is the EPS of the company? In this EPS, I'm telling the equity guy, you have to contribute 3 rupees 50 paise. You have to contribute 3 rupees 50 paise. He says, okay, take it. Okay, take it. So I subtract this 3 rupees 50 paise. 6 rupee 50 paise is FCFE. 6 rupee 50 paise is FCFE, free cash flow to equity shareholder. Let me explain. EPS is 10 rupees. I tell equity guys, bring 3 rupees 50 paise. Bring 3 rupees 50 paise. They say, please take it. Please take it. Give me my balance 6 rupees 50 paise. I can come to the 650 in multiple ways. What was the FCFF? 5. In this 5, add the new loan taken. Add the new loan taken because this is like inflow. This is like inflow. So 5 plus 1.5 is also 6.5. 5 plus 1.5 is also 6.5. There are multiple ways of calculating FCFE. From FCFF, what you can do is you can add back loan taken. You can add back loan taken and subtract something called as interest net of tax. Subtract, because in FCFF calculation, interest is not subtracted. In FCFF calculation, interest is not subtracted. To cut it short, I would want you to just visualize whether there is an inflow or outflow between the owner and the company and accordingly do the calculation. Go through the next example. Try doing this FCFE. This is FCFE. Try doing it. Let's see. You this one. No, no. This is new question. Okay. The below one, I cannot. The answer will get reflected. So the below one. Give it a try. I'll discuss it. Give it a try. How much is the FCFE you're getting? Okay. Let's discuss quickly. I want you to calculate FCFE. What is the starting here? PAT. In PAT, interest would have been subtracted, and that is right also. That is right also because I'm doing FCFE. I'm doing FCFE. If I was doing FCFF, I would have added back interest net of tax. I would have added back interest net of tax. Capital expenditure and depreciation is same, so no problem. No working capital changes there. So 10,000 debt repayment is an outflow. Debt repayment is an outflow for FCFE calculation because this is not a cash flow between the owner and the company. It's not a cash flow between the owner and the company. So your number is going down to 10,000. 10,000 minus 2,000. 10,000 minus 2,000, it is going down to 8,000. If you take any loan, it is inflow. If you repay any loan, it is outflow. Clear? Any doubts on this? Let's come to the next one. Earnings after tax 600, one time income after tax 200, one time expense 100, depreciation 50. How much is the free cash flow for valuation under cash flow based approach of valuation? Now concept is very simple. What we are trying to say is when you do your cash flow calculation, try to consider something which is likely to be repetitive in nature. If some one-off items happen, that should ideally not be considered for valuation. One-off item should ideally be not considered for valuation. How much is the PAT here? 600. In this, remove this 200. In this, remove this 200 because this is a one-time income. This is a one-time income. It was considered in 600 calculation. Remove this 200 now because this is an income. This is an income. So I'm removing the income 200 and I'm adding back the one-time expense. Maybe I've not added the word. This is also after tax. Depreciation is a non-cash item. Depreciation is a non-cash item. Basic logic is one-off items. Let's not consider in the calculation. Let's not consider in the calculation. Any doubts on this? Can we proceed? Okay. When I was showing you so many examples, there were this capital expenditure, depreciation, capital expenditure, depreciation. Now, practical world, let's assume I have fixed asset of 10,000. Closing my fixed asset is 12,000. Closing my fixed asset is 12,000. In this, what happened is depreciation was 1,000. Depreciation was 1,000, which means addition is 3,000. Addition is 3,000. So 10,000 was the opening WDV, depreciation, capex, and closing WDV. This is what has happened. Now, for cash flow purpose, you have two choices. You can add back 1,000 and deduct 3,000. You can add back 1,000 and deduct 3,000. This 3,000 is called gross capital expenditure. This 3,000 is called gross capital expenditure. 3,000 gross. 3,000 is gross capital expenditure. Some question you will not have any idea on what is depreciation, what is capex. Let me not get into it itself. If fixed asset from 10,000 is increasing to 12,000, it means net capital expenditure is 2,000. Directly just subtract this. Directly just subtract the net capital expenditure. If you are doing gross, subtract gross, add back depreciation. Subtract gross and add back depreciation, because this is a doubt which many students keep having, because question will say 10,000 is becoming 11,000. They think 10,000 becoming 11,000 means capex is 1,000. No, capex will not be 1,000. Capex will be more than 1,000 because there would have been a depreciation subtraction. There would have been a depreciation subtraction. So just to explain, gross capex is capital expenditure done by the company, which is reflected as additions in fixed asset schedule, Net capex is increase in net fixed assets, wherein gross capex is adjusted for depreciation. You have two choices. You can directly subtract net capex, or you can deduct gross capex, that is 3,000, and add back 1,000, net 2,000 will get subtracted. Net 2,000 will get subtracted. Can you please calculate this? What will be the gross capital expenditure here? Please think and let me know. You think and let me know. Think and let me know. What is the formula for fixed asset turnover ratio? Sales by fixed asset. If sales increase by 20%, fixed asset also has to increase by 20%, so that ratio will remain same. So opening fixed asset is 10,000. Closing has to become 12,000. The gap is net capex. The gap is net capex. What is gross capex? 10,000 minus 1,000 balancing figure, and final value is 12,000. Balancing figure. I think those are the numbers I took. 10,000. Depreciation was 1,000. Closing is 12,000. So net capex is 3,000. So gross capex is 3,000. Gross capex is 3,000. Any doubts on this? If ratio is to be maintained, both numerator and denominator has to increase by 20%. Working capital, I've already discussed this. Increase in working capital is an outflow. Decrease in working capital is an inflow. There is one important line. We need to be cautious in computation of change in working capital in case there is a change in growth rate.
Sir,
Sorry, yeah, tell me.
sir, one doubt, sir. In the last question, for the additions, we don't need to calculate depreciation, sir. It is assumed that the at the year end the additions is happening or
The
what?
question said depreciation is only on opening WDV. The question is saying that.
Okay, sir. Okay. Sorry, sorry.
Okay, coming to this, question says, guys, whenever working, because all this now, whatever adjustments I'm talking about, all this will get combined together and come as one question. That is what is going to come. So I am just breaking it into small parts so that it's easy for you to absorb. And then when I do it together, you will be in listen mode and understand the calculations alone, because you will not be able to do it along with me, because it will go at a very rapid pace, because I'll have to do 7 years, 8 years, 5 years kind of a calculation. Here, revenue of the company is 4,000. It will increase by 20% for first year, second year, and thereafter it will increase by 10%. Now I'll tell you what students do and where the error come. What is that caution I'm talking about? Let's look at revenue. 4,000. Working capital is how much? 1,000. This is year 0. Next year revenue increases by how much? 20%. So 4,000 will become, working capital will become, increases 200. Increases 200. From 1,000 it has become 1,200. From 1,000 it has become 1,200. Second year, 4,800 plus 20%. 25% of this. Thousand increases 240. Now at this stage, the student has already made up his mind, saying that first year we wrote 200, second year there's a 20% increase, so working capital is 240. Third year it should be 240 plus 10%. His mind has already made this. He has already made this in his mind, which is wrong. Which is wrong. What he has done in his mind is he thought 200 was the first year increase, second year extra 20% has happened, 240. Now comes the caution. Third year, tell me the revenue. 5760 plus 10%. Tell me 25% of this. 15. How much is the increase? So increase is not 240 plus 10%. Increase is only 144. Increase is only 144. He has already made in his mind saying that 200 plus 20% plus 10% I'll do. What will happen is I showed you only 2 years. I say we'll do it for 5 years. So first year you will write 200. Second year you see extra 20%. So your mind is tuned. Third year you again will see extra 20%. Fourth year again you will see extra 20%. But fifth year is where the disaster will come, where they have changed the growth rate. Where they have changed the growth rate. So whenever there is a change in growth rate, don't try to use any shortcut. Please do proper calculation and you will see a huge difference in working capital. You will see a huge difference. No shortcut will work here. No shortcut is going to work here. Clear? Any doubts on this? Next, the next approach of valuation is relative approach of valuation. What is relative approach of valuation is? Let me give you an example. Very simple example. Bharadwaj Institute, 20,000 students. Another company, 40,000 students. This company market is giving value of 100 crores. 100 crore. So what I am saying is 40,000 student, 100 crore. What is 20,000 student? 40,000 student, 100 crore. What should be the value of 20,000? This is called valuation by proxy company or relative valuation. Relative valuation is you find out something which is making sense, which is relevant to the industry. Do proxy company, copy paste for your company. Copy paste for your company. Let's take an example. You have decided to value C Limited on the basis of what? Market to sales approach. What is market to sales approaches? You will look at the sales of your company and multiply this with some number. Multiply this with some number. Company A market value is 400, sales is 500. Company B market value is 450, sales is 600. And company C is at 800. You don't know what is the value. You don't know what is the value. The approach you want to do is market value to sales. I'll show you the calculation. You will understand it then. Market value, sales, A, B, C. What is the value of A?
400.
How much is the sales?
500.
B.
400.
So MV to sales 400 by 500 is how much? 0.8. 450 by 600.
75.
Ideally both should be same. Ideally both should be same. If it's not same, I cannot help it. If it's not same, for my company, average of this. For my company, average of this. For my company, it should be average of 0.8 and 0.75. Average of 0.8 and 0.75. It's not that you have only one proxy company, you can have multiple proxy company. So what is the average of this? What is the sales of our company? Do into 800, you'll get the value. 620. So using the proxy company, I arrive at a value of 620. Using the proxy company, I arrive at a value of 620. Clear? Any doubts on this? Any doubts on this? Okay, let's take a break of 15 minutes and then proceed. I've discussed your cash flow model. I've discussed relative valuation. What is relative valuation? Is valuation by multiple. Technically, you take a proxy company and then do the valuation. Then there's something called as breakup value approach. Let me discuss all the approaches first and then we start doing the questions. Breakup value approach means ITC has multiple businesses, FMCG, hotel, you have tobacco. Every business can be valued using different multiple. Every business can be valued using breakup value means I break the company into various parts. I break the company into various parts. One business using Gordon's model, another business using Walter's model, another business using sales to market capitalize. So you can try to do using different methods and then arrive at a value. Example, Reliance Industries has three divisions. Division A is to be valued based on capitalization divided by sales. Division B based on capitalization by EBITDA and Division C based on capitalization by operating income. The data of the three divisions is as under. Capitalization sales for industry is how much? 10 times. Division A, what is the sales? So value of this division is 10 into 4 lakh. 10 into 4 lakh. Like P multiple, you have capitalization by sales multiple. Division B is based on capitalization by EBITDA. What is the EBITDA multiple? 20. Second division. Third division is capitalization by operating income. What is operating income? Is EBIT. What's the multiple? 25. Put together, I think answer may or may not match. I've done some I think there is some typing error, I remember. 10 into 4 lakh is 40 lakh. 1 lakh 50 into 20 is, I think I've corrected that. Then I've corrected. So put together the value of the three businesses is this. You can value businesses using different ways. Breakup value means breaking the company into multiple segments. One company based on FCFF, another company based on sales by capitalization, another company P multiple approach, another company net assets method approach, another company earnings capitalization method. Your wish how you want to do the valuation. Once you do, add up all the value. That's the value of the company. Any doubts on this? Okay, this is also frequently tested. Future maintainable profits approach of valuation. What is FMP approach of valuation is? You will be given some profit today. You need to calculate future maintainable profit. What is future maintainable profit? Is current profit, add or subtract all extraordinary item. Add or subtract all extraordinary item. Example, existing PBT is there. Deduct extraordinary income because this will not get repeated. Add back extraordinary expenses. If any new process, new product you are going to do, add that profit, you will get the future maintainable PBT. Future maintainable PBT. All adjustment has to be done before tax because all these are taxable item. Then you get your future maintainable profit after tax. Like you have cash flow by cost of capital, CF by KC we had done in one question. Here you have future maintainable PAT divided by capitalization factor, divided by capitalization factor. Sometimes they will say you try to do P multiple approach. You try to do P multiple approach where you start with future maintainable PAT, deduct whatever preference dividend is to be paid. You will get EA, ES, number of equity share, EPS, P multiple, MPS. That is using P multiple. Let's look at an example. Eagle Limited reported a profit of 77 lakh after 30% tax. Can you tell me what is the PBT? PBT is 110. In this, accounts revealed that income included extraordinary item of 8 lakh. Income included extraordinary item of 8 lakh. This 8 will not continue. This 8 will not continue. So subtract income of 8. Subtract income of 8. And extraordinary loss of 10. Add back. Add back extraordinary loss. Then you have new product which will give you profit of 28. This is future maintainable PBT. Future maintainable PBT. How much? Subtract 30% tax on that. Clear? Can you please try doing this? PAT is 10 lakh. PBT is going to be 20 lakh. Extraordinary income is 5. I'm removing that. 15. New product will give you 20, which is 35 lakh. After tax, it is 17 lakh 50,000. Clear? Okay, there's another two methods. Net assets, let me do all of this and then I'll quickly summarize all the methods. Okay, net asset method is book value approach. What is book value approach? Share capital plus reserves and surplus minus fictitious asset was one approach. Second approach was total assets minus your all liability, everything. Net asset method is nothing but when you did NAV, no, what were you doing? You were writing market value of asset. So you will adjust the asset as well as liability. You will adjust the asset as well as the liability in net asset. Land and building, you will upward value it. Plant and machinery, you may value it downwards. Debtors, you may value it downwards. Cash, so whatever adjustment you want to do, you can do all adjustment. Without adjustment is called book value. With adjustment is called net asset value. With adjustment is called net asset. Realizable value of asset minus settlement value of liability. Realizable value of asset minus the whatever assets are there. Let me see if there's an example. Okay, example is there. I'll explain there. Okay, this example will not help, but I have fixed asset of 10 lakhs in books of accounts. This 10 lakh for net assets method, I can even write as 40 lakh. I can even write it as 40 lakh. Debtors is 15 lakh. I can even write it as 5 lakh because those are realizable value. Those are real value of assets. Settlement value of liability. What is settlement value of liability? Balance sheet is there and they say contingent liability is there. You have to take a call whether this contingent liability will become a real liability or not. If you assume it will become a real liability, subtract it. Subtract it in your calculation. Earnings capitalization method is nothing but your D by KE. Ignore the G, ignore the minus G part of it. D by K is the price. Instead of saying D, I'll say E by KE. E by KE. Future maintainable profit which you calculated divided by the capitalization rate. Future maintainable profit divided by the capitalization rate. This example, leave it. I've already done this example when I did book value calculation. The same, I did not make adjustment. Ideally, I should remove it from here and then keep it there only. Look at this. This you will understand. H Limited has total assets of 1000 crores. It has preference capital of 100, long-term debt of 200, current liability of 300, contingent liability of 200 will crystallize to the extent of 25%. Land is 20% of total assets and its current value is 4 times of book value. Its current value is 4 times of book value. What is the value of equity as per net assets method? What is the value of equity as per net assets method? See, if I tell you to do book value method, 1000 minus 100 minus 200 minus 300, done. That's all. No adjustment, nothing needs to be done. Let's do net assets method. Let's do net assets method. particulars amount. First is assets, land, other assets, land and other assets. In fact, this example is more difficult than the sums which we are going to do. So once you understand this, the sum is going to be very simple. How much is the total asset figure? 1000. In that land is how much?
20%.
Which is 200. We are saying that is what?
4 times book value.
4 times of book value, which is 800. Other assets is going to be 800. Total assets 1600. Now we will subtract various liabilities which are there. What are the liabilities given? Preference. If no extra data is there, you can subtract this. Extra data can increase the liability, can decrease the liability. Preference is how much? 100. Debt 200. Then and you have contingent liability which can become an actual liability. How much is the contingent liability? You have 200 and it will crystallize to the extent of 25%. Crystallize to the extent of 25%. So 200 into 25% is 50. So this will give my value of equity. After doing all this adjustment, I get a value of 950. I get a value of 950. Net assets method gives me full freedom to make adjustment. Gives full freedom to make adjustments. That is what net assets method say. A company has total asset of 20 lakh, outside liability of 4 lakh. Assets have realizable value equivalent to extent of only 80%. But there's another headache. There is a liquidation expense. So assuming you have to liquidate the company today, assuming you have to liquidate the company, how much assets will give you? 16 lakh. In that 16, pay 4 lakh of outside liability, pay 1 lakh of liquidation expenses, pay 1 lakh of liquidation. This is not technically net asset value. This is net realizable value. This is net realizable value. Only difference being is in net asset value, you're not planning to sell it. You're not planning to sell it. Net realizable, you want to just close the company. You just want to close the company. Any doubts on this? ABC Limited has automobile division whose business is 1000 crores. Liability is 500 crore. The settlement value of liability is 20% more than the book value. Company plans to sell this division and has received a quote of 450 crores. Buyer will take over all the liability. What should be the decision of ABC Limited? First, value this division as per net assets method. Tell me the value as per net assets method. 1000 minus what? 600. I want 400 crores. He's giving me 450 crores. Please take over my business. Please take over the division. I wanted only 400 crores. You are giving me 450 crores. Now this may look very, very simple adjustment. This is what is there in 1, 2, 3, 4 question which I'm going to do. But there extra 20 data will be there and you get confused. That is the only problem. The problem is your clarity is there when I give you one concept. When I add a second concept, clarity is there. But the moment I add third concept, you confuse yourself and that is where you're not able to do. That can come only with practice. But yes, I want you to keep revising only these concepts so that you're able to touch the bigger problem. Compute the value of company under capitalization of earnings method. Capitalization of earnings method is earnings capitalization method. EPS 10, share price is 100, expected annual maintainable profit is 20 lakh. Annual maintainable profit is 20 lakh. So for this method, I need first capitalization rate. I need first capitalization rate. What is capitalization rate? Is like cost of equity. Like cost of equity. A simple way is dividend by market price. If you don't have dividend, earnings by market price. If you don't have dividend, earnings by market price, because we are going to capitalize the earnings. We are going to capitalize. I can tell you in different way. Can you check this and tell me what is the P multiple? 10. Value is going to be profit into 10. Value is going to be profit into 10. Earnings capitalization is not a new method. It is P multiple approach only. It is P multiple approach only. PAT is 20 lakh into 10. PAT is 20 lakh into 10. Let's look. Any doubts? Can I proceed? T Limited recently made a profit of 50 crore, paid out 40 crore as dividend. Average P ratio of the industry is 9. As per balance sheet, shareholder fund is 225. What is shareholder fund is? Share capital plus reserves are fixed assets plus current assets minus all your liability. In case the company is liquidated, building will give you extra 100 and stock will give you lesser 25. What is the value of company as per NRV method? Think and let me know. Value of company as per NRV method. Think, anyway, I'll discuss.
$300, sir.
Correct. So we have 225. How much the building is going to give extra? That will come to me only. That will come to equity guys. So 325. Stock will give 25 less. So 300 is the value as per NRV method. Value as per, in short, you will have to adjust 100 upwards, 25 downwards. Net cash flow and book value approach with floor value. Okay, this is there in 1-2 questions, which is there. If you want, some companies will value as per cash flow based approach where they'll give residual net cash flow. What is residual net cash flow is? In simple words, residual cash flow means cash flow after meeting all my requirements. Cash flow after meeting all my requirements. So logically speaking, any residual cash flow can be paid as dividend. Any residual cash flow can be paid as dividend. So value as per net cash flow approach or residual cash flow approach is nothing but dividend by KE minus G. Dividend by KE minus G. That dividend is like residual cash flow, and that residual cash flow can also be called as FCFE, free cash flow to equity shareholder. That is after meeting every requirement, leftover money. After meeting every requirement, leftover money. Book value approach, I need not talk about it. You know what happens in a book value approach. Book value is share capital plus reserves. Assuming you do both. Assuming you do both. In this, the question will ask what is minimum price, what is maximum price. Minimum price is very simple. Lower of the value of the two approaches. What is maximum prices? I'm going to acquire a company. I'm going to acquire a company. Simple. Post merger value minus the pre-merger value. Post-merger value, maximum consideration. Maximum consideration. Post-merger value minus the pre-merger value divided by number of shares. In all this analysis, there will be something called as a floor value. What is floor values? Below this, I don't accept anything. Below this, I don't accept anything, and that floor value is current market price. Because below current market price, why will I accept anything? Below current market price, why will I accept anything? You will understand this better now here. Let's see. R and S are in the same industry. S is planning to acquire R Limited. S is planning to acquire R Limited. How much should be the maximum consideration payable? There's a PAT given. There's a residual net cash flow given. What is residual net cash flow? Is dividend. Technically like dividend. And there is a required return on equity, which is cost of equity. Required return on equity is cost of equity. I'll go back to what we did in merger. AC, TC and merge firm. AC, TC and merge firm, right? Particulars, AC, TC, merge firm. Point number 1, net cash flow 90 lakh 10,000, 54 lakh 87,000, 1 crore 85 lakh. Who's query? Okay, I also got that mistake. So my mind was thinking that it will always be AC is to TC. Okay, it's the other way around. Maybe I wanted to test you. I myself made a mistake. That's okay. So let's change it. Particulars S Limited, R Limited and merged. Net cash flow 5487, 90 lakh 10,000 and 1 crore 85 lakhs. Cost of equity. What's the cost of equity of S Limited? 05 R and merged is 12.5. Value of company 5487 by 13.05%. Goes on like this. You can keep completing like this. What is maximum consideration? Post-merger value minus the pre-merger value of acquiring company. Post-merger value minus the pre-merger value of acquiring company, which is this minus this 10 crore 60 lakh, 10 crore 59 lakh 54,023, 10.60 crores, 10.60 crores. Any doubts on this?
This minimum is better.
No, lower of the two. That what you are calculating is not I'll do it in the problem. Any doubts on this? Okay, my internal reconstruction notes are here. I thought it should have been there, but internal reconstruction notes are here, where capital reserve first needs to be calculated, which is items increasing the net worth and items reducing the net worth, and then prepare a balance sheet. I'm kind of done. Just give me a minute. Okay, there are still some more concept, but I'll take it later. Quickly just write it this. Quickly just write what I'm telling you to do. Valuation. I may split into 3, 4, 5. I don't know the number of items, so you manage space accordingly. First is cash flow. FCFF, cash flow FCFF, FCFE, residual cash flow. Cash flow FCFF, FCFE, residual cash flow. Assets, net assets, book value, net realizable value. Net assets, book value, and net realizable value. What is net assets is taking the market value, book value is without adjustment, net realizable value is realizable value of the various items. Earnings, P multiple, earnings capitalization, FMP based. Okay, both are same. Earnings capitalization, FMP is based the same. Earnings capitalization and P multiple approach. Earnings capitalization and P multiple approach. Relative valuation. Valuation by multiple. Valuation by multiple. In valuation by multiple, you can keep bringing anything. Okay, it could be based on sales to capitalization. It could be PAT to capitalization. It could be EBITDA to capitalization. It could be number of employees to capitalization. It could be number of students to capitalization, and it can be capitalization by number of students. It can also be number of students by capitalization. Whatever ratio they give, you please follow that. Both can lead to some variation in answer. When you do, you'll understand it. Whichever approach. These are the only approaches? No. Apart from that, Walter, Gordon, which you do in your normal security valuation, that can also come as approach of valuation concept, which is called computation of merger NPV. Now listen, I'm planning to acquire another entity. My purpose of acquiring this entity is to acquire its assets, run business, and earn profits out of it, or cash flows out of it. So the question has given how much cash flow you are going to generate in year 1, year 2, year 3, year 4, year 5, everything is given. So it's a pure capital budgeting problem. Where every year how much you will get is known. What is not very clear is what is consideration. Or what is your initial outflow? Because for capital budgeting, step 1 initial outflow, step 2 in between flow, step 3 terminal flow. You consolidate and calculate NPV. Now, unfortunately, students make mistake in writing the initial outflow. I'll explain first with an example. Initial outflow on acquisition. Cost of acquisition would include consideration given in cash or other than cash. Many a times students think that when I acquire a company, I need to pay only in cash. That is for capital budgeting purpose. I'm talking about capital budgeting. I'll ask what is the initial outflow. You say we paid 2 lakh rupees, so 2 lakh is the outflow. Outflow can be in cash. Outflow can be in other than cash. What is other than cash? Free issue of equity shares. What is free issue? I've issued equity shares. I did not get any money. Why did I not get money? Because he has given his business to me. You could be issuing something to preference shares. You could be issuing something to debenture holders. You could be paying something on the liability side. You see every item, no? whatever you pay to them, whether in cash or in other than cash, all are your outflow. All are your outflow. You have certain items in the asset side of the balance sheet. What you did is, before to start, you sold off some of the assets. You sold off some of the assets, and balance only you are continuing. Balance only you are continuing. So whatever you continue is fine. Whatever you sold off will reduce your outflow. Will reduce your outflow. So example, market value of equity issued, debenture, preference capital issued, loan taken over or repaid. What I did is, I did not repay the loan, but I took over the liability in my balance sheet. That is also outflow only. That is also outflow. How is it an outflow? If I take a new loan, I'll get some money. I'll get some money. Here, without getting any money, in my balance sheet, a loan liability is arising. In my balance sheet, a loan liability is arising. So again, I'm repeating, anything which you give to all your liabilities, either in the form of cash or other than cash, either in the form of cash or other than cash. What is other than cash? Equity shares issued, preference share issued, loans issued, debentures issued. All this will form part of outflow. What can reduce my outflow? If there any realizable value. There's any realizable value. Let's understand this with an example. A Limited, just give me a minute. A Limited has acquired business of B Limited. It has issued 40,000 equity shares of 20 each. This is outflow. 40,000 equity shares of 20 each. Debentures, again outflow. Free debentures is also outflow. It has made a payment of 6 lakh to creditors. This is very clear to you, because this only students think is outflow. They only think that this is the outflow, but there are other items of outflow which is other than cash. How much is the initial outflow for the purpose of computing merger NPV? Shares issued is outflow, debentures issued is outflow, cash paid is outflow. Everything will form part of outflow. Everything will form part of outflow, whether you give cash or you take it in the form of other than cash. Other than cash. Clear? Any doubts on this? Okay. There is one type of an exam question which is repeated frequently, called as impact of WACC on valuation. Whenever you do valuation of a company, WACC is the discount rate we use. And at inter level, you would have learned there are two types of WACC. WACC based on book value, WACC based on market value. So I can ideally use any of them, but logically more important is WACC based on market value. So if you use wrong WACC, you will get wrong value. If you use wrong WACC, you will get wrong value. So in these type of question, what will happen is, they will give you the value. Compute wrong WACC by using value of firm and free cash flow. They'll give the cash flow. They'll give the value of the firm. You first calculate what was the wrong work WACC used. Using the wrong WACC, you will get the weights. How this happens, you'll understand. Then you will have to get the correct WACC. After getting the correct WACC, you will have to get the correct value of firm. So wrong WACC, wrong value, wrong weights, correct WACC, correct value of firm. This is the pattern. Example, cost of equity is 20%, cost of debt is 10%, WACC based on book value is 12%. Cost of equity is 20, cost of debt is 10, and WACC is how much? 12. Now I need to understand what was the weight of debt and what is the weight of equity. Cost of equity is 20, cost of debt is 10, and your WACC is 12. How do I do this calculation? Is equity, debt. What is the cost of equity? 20 debt. This is A. This is 1 minus A. Put together it is 1. A and 1 minus A, and put together it is 1. So 20 into A is 20 A. 10 into 1 minus A is 10 minus 10 A. Put together what was the WACC in the 12. So the total of this 20 plus 10 minus 10A has to be equal to 12. 20 plus 10 minus 10A has to be equal to 12. So 20A plus 10 minus 10A is equal to 12. Can you tell me what is the A? 0.2. So equity is 0.2, debt is 0.8. Equity is 0.2, debt is 0.8. This is what you have used. This is what you have used. You have used equity 0.2, debt is 0.8. This is weighted average format. This is the weighted average format. Now comes the surprise. They are saying value of equity is 3 times of its book value. You said 0.2, no 0.2. Do 3 times of it. Do 3 times of it. And market value of debt is 9/10. 9/10. You took 0.8, no 0.8. Do 9 by 10, which is 0.72. And based on this, you will get the correct WACC, which is presented here. 0.6 and 0.72. So correct WACC is 14.55%. Correct WACC is 14.55%. So once you get the correct WACC, you can get the correct value of firm. I'll repeat again: wrong WACC, wrong weights, wrong value, right weights, right WACC will give you the right value of firm. Any doubts on this? Okay, 43 has an illogical element. There is not a logical element, but this is part of your study material. I don't want to discuss much. They have given something called as per share earning value. I've done all possible Google. Never I've heard this term called per share earning value. Nowhere there is this term like per share earning value. Institute has something. They have done some calculation. You present it exactly if it comes in exam because it is part of your study material. I cannot do anything here. I don't know what to explain also. So this is I've anyway written here. Not a logical item. Not a logical item. So I am not explaining anything on this, but there's a question on that. And the question is nothing different. This question only. So you need not even see the question. It's the same MCQ being presented in a question there. Okay, this is a good example. Funding required for growth. An organization, when it grows, we have seen in a problem that fixed assets will increase, current assets will increase, current liability will increase, because everything will increase whenever there is a growth happening in an organization. So ICI asked this in an exam scenario where they say growth is happening. You tell how much money is needed. You compute it. Then they asked, will this money come from equity, preference, debt, short-term debt, long-term debt? You do all that calculation and present it in exam. That was the requirement of the problem. So typically an organization seeks additional funding to accommodate growth whenever growth happens. This is because as revenue increases, there's a corresponding rise in fixed assets and working capital. Will there be an exact increase? No, practically it is not an exact increase, but there will be an increase. There will be an increase. So what they did is funding required is equal to increase in capital employed. What is capital employed? Is fixed assets plus current assets minus current liability. Where is the capital? And for capital employed purpose, short-term debt is also part of capital employed by many authors. Many authors practically think short-term debt is also part of capital employed. Short-term debt is not a current liability. Short-term debt is not a current liability. Why we take that assumption is, if my revenue increases, debtors increases. Because why debtors increase? More revenue, more credit, more debtors. If revenue increases, purchases will also increase. Purchases will also increase. Along with that, creditors will also increase. But if revenue increases, short-term debt cannot increase. Revenue increases, short-term debt cannot increase. How can short-term debt increase? If you borrow more. So that's a different thing. So there is no linkage between revenue and short-term debt. So many authors believe current liability should not include short-term debt. Current liability should not include short-term debt. I used to work in a rating agency where this is what we used to do. We were ignoring short-term debt as part of the current liability, and we used to consider this as part of capital employed. Let's see this. Total asset 4,000, current liability 1,000. Total asset is 4,000. Total asset includes the current asset. So capital employed is 4,000 minus 1,000. Capital employed is 4,000 minus 1,000. What is capital employed? Is fixed assets plus current assets minus current liability, or debt plus equity plus preference. So my capital employed is 3,000. Revenue increases by 20%. Capital employed has to increase by 20%. When I say capital employed has to increase, assets is increasing, current liability is increasing. So somewhere bring either equity, debt, preference, retained earnings, whatever you want to bring. So extra 600 lakhs I need now. Extra 600 lakhs I need. I'll explain again. If revenue increases in an organization, along with that, if nothing is given, fixed assets will increase, current assets will increase, current liabilities will increase, equity reserves and all will not increase. That depends on what you decide. That is what the CFO's role is. He can decide in what mix he wants to raise that money. Any doubts till this? Intrinsic value of equity, some question may ask. What is intrinsic value of equity? Is value of equity is equal to value of firm minus value of debt, which is right. But some question will give, just give me a minute. The internet got stuck. Okay, so intrinsic value of equity is very simple. Value of firm minus value of debt. But when you calculated the cash flows, did the valuation of firm, you are telling that Bharadwaj Institute has one building separately available. Separately available. That building was never considered in the calculation because it is non-operating for me or non-core for me. That building I can sell for 50 crores. That building I can sell for 50 crore. If you sell that building for 50 crore, entire 50 crore will go to equity gain. Entire 50 crore will go to equity gain. So intrinsic value of firm. What is intrinsic value of firm? Present value of future cash flows. FCFF plus market value of non-core assets. Plus market value of non-core assets. This was never considered in the cash flow calculation. Never considered in the cash flow calculation minus the value of debt. Minus the value of debt. Value of firm arrived by discounting cash flow of core operation 1000 lakh. Value of debt 200. Market value of non-core asset is 100. What is the intrinsic value of equity? 1000 plus extra 100 minus 200. Extra 100 minus 200. An extension of this you will learn enterprise valuation, which I'll discuss in valuation of share. Clear? Now at this stage what we have covered is the normal companies. Now I'll be moving to something called as distressed company valuation. Distressed company, because it's newly introduced, I may go little slower than what we have been doing earlier, but not much. Yes, sir. Yeah, tell me.
Sir, is the intrinsic value same as the market value? Because in the market value, it factors all the factors, right? Even the non-core assets factor also. So it will almost equate the intrinsic value, right?
Yes, it has to be, but sometimes there can be up or down.
Okay, thank you.
Okay, now I'll move to distressed company valuation. I think valuation, I'm almost done with every question which I wanted to discuss. A good question is 45. Just try this at home. In case you struggle, let me know later. 45 is a good problem for you to do. I'm not discussing it as part of the class now. Otherwise, all major questions, whatever I wanted to discuss is discussed. Now I'll come to distressed company. What is distressed company? Is a company which is going through certain financial troubles, How does trouble come? Trouble can come from two sources: operating synergy, financial synergy. So operating risk and financial risk. What is operating risk? In your cost, you have a lot of fixed cost. In your financial risk, you have a lot of fixed capital. What is fixed? Lot of fixed cost. Bharadwaj Institute during COVID time had zero revenues, but we had a lot of fixed costs. Variable cost is not a problem. Variable cost, if revenue is not there, variable cost will not be there. But fixed cost, even if revenues is there, I will continue to have it. The second type is your fixed liability. I had debt capital, I had preference capital. Company is not doing well. He is saying pay interest. Equity guys will agree to whatever I give, because if profits are not there, I don't pay. So distress is one where I'm not able to meet my fixed commitments. What are the fixed commitments? Fixed cost are fixed interest. Ignore the preference. Preference is not there in most of the time. Distress can be because of operating leverage, which is fixed cost, or financial leverage, which is fixed capital. Then comes the most important issue. You cannot say a distressed company is a going concern. If it's not a going concern, where is the perpetuity valuation coming into picture? Because perpetuity assumes it will be there for indefinite period. Still, in some of the question we'll do perpetuity, because they'll say it will continue for infinite period and all. But logically speaking, for this company, for a distressed company, going concern assumption may not hold good. And logically, because of that, distressed company gets hit on two sides. One, when you do your cash flow calculation, you are saying you'll consider only 5 years. You are not considering more. Second, I ask you discount rate. You increase the discount rate also. Because discount rate is based on the risk of a company. Distressed company, obviously risk is on the higher side. So you are penalizing on both the side. When I do year cash flow PV of DCF, cash flow is reduced, discount rate is increased. So automatically the value is going to be on the lower side. In that we have multiple approaches. First approach is modified discounted cash flow approach. Now what does modified discounted cash flow approach is? Understand this and then I'll show you an example. Okay. What is modified discounted cash flow approach? All this is there in your ICA material. ICA has given 0 questions. They have not given any questions. So I'll discuss some example questions so that you understand, get more clarity. Modified discounted cash flow approach basically means, can you arrive at best situation, worst situation and normal situation for a company? Do best value, normal value, worst value. Give a best value, normal value, worst value and attach probability to all the three. Attach probability to all the three. What is final value? Weighted average. What is final value? Weighted average. Then he is saying, doing this three things and all impossible for me. Doing this three things and all impossible for me. You are telling do best, do worst, do normal. I'm not able to do. Then the next option is, for example, here you have arrive at various possible scenario, do valuation of each scenario, do valuation of each scenario, derive probability for each situation. Value of firm is weighted average of various possible value with probability being the assigned weight. Example, optimistic scenario, best possibility 100 crore value. Base case scenario, only 50 crore value. Worst case, only 10 crore. Weighted average 44 crore. This is the value of the entity. But doing this is slightly difficult. Doing this is slightly difficult. So ICA material has talked about this, saying that if you cannot do scenario analysis, at least in the cash flow, reduce the cash flow to consider probability of distress. What is probability of distress? Is the company will fail. The company will fail. So I wrote the cash flow saying 100, 200, 300, 400, 500. He's saying don't write 100, make it 80. Don't write 200, make it 150, because there is a probability of distress. There is a probability of distress. What is probability of distress? Is you will not survive. You will not survive. So if you are not going to survive, 100 lakhs will come if I survive, which has 70% chance only. And if I don't survive, I'll get 0. If I don't survive, I'll get 0. So put the cash flow downwards. Put the cash flow downwards, because you're not going to survive. You're not going to survive. That is what the first method is saying. ICI material has just talked about this, adjusting the cash flow part alone. Then comes the second method, which is liquidation value plus going concern value, or DCF valuation plus distress value. DCF valuation plus distress value. Now what they are saying is, assume two scenario. One, you are liquidating the company, get me a value. Second, you assume it is a going concern. It is a going concern, you get me a value. One is liquidation value, which will be very less. Second is a going concern value, which will be very high. Liquidation multiply with probability of default. Going concern multiply with probability of survival. Liquidation multiply with probability of default. Going concern multiply with probability of survival. If you are going to survive, multiply with probability of survival. If you are going to be liquidated, multiply with probability of default and get an answer. Get an answer. This is also called as DCF valuation plus distress. DCF is going concern. Distress is immediately sell off. Let's understand. Liquidation values arrived assuming company may be liquidated over the near term. Liquidation value must be lower than going concern value. Must be lower than going concern value. This is normally arrived through NRV approach of asset valuation, net realizable value. You are selling all of your asset. Going concern is the present value of future cash flow discounted at investors' required rate of return. Put your cash flow, get the calculation. What is the final value? Liquidation into probability of distress, going concern into probability of survival. This example is for the next approach. I don't know, I have added it here. Okay, the examples got interchanged. This example, the example in the next one will work for the approach. Value of going concern is how much? Distress 50 crore. Probability of survival is 40%. Probability of survival is 40%. Now write value of company is equal to, right? Value of company is equal to 50 into, what is the probability of distress? 50 into what? 60% plus 100 into survival is 40% chance, which is 100 crore, and default is 60% chance, which is 50 crore. Put together the value is 70 crores. Clear? Any doubts on this? The third method ICI books talk about is APV approach, adjusted present value approach. Now, what is adjusted present value approaches? You did your earlier approach, no? Going concern, you did probability of distress, you do all of that, get a value. get a value. Along with that, there is one extra add-on needs to be done. One add-on needs to be done. What they are saying is adjusted present value approach basically says if you have debt in a company, if you have debt in a company, there is a benefit associated with the debt. There's a benefit associated with the debt. APV approach says if you have borrowing in your company, there's a benefit. What is the benefit of a borrowing? Tax saving. So when you do your calculation, tell me what is the present value of future tax benefit. What is the present value of future tax benefit? I'm not sure how many of you will remember. You would have done Modigliani-Miller approach at CA Inter, where you would have done value of levered firm is equal to value of unlevered firm plus amount of debt into tax rate. Amount of debt into tax rate. That amount of debt into tax rate is the tax benefit of the debt. Is the tax benefit of the debt. So APV approach says you please calculate how much tax you are saving every year. If it is 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, 7 year, 8 year, 9 year, 10 year, write the tax saving. Discount that at pre-tax cost of debt. Discount that at pre-tax cost of debt. Again repeating, discount that at pre-tax cost of debt. Why pre-tax cost of debt? Because this benefit, that the benefit is based on the debt instrument, and what is the risk of the debt instrument is the interest rate you pay. See, logic is very simple. Any cash flow you take, you should discount that at the risk which is prevalent for the cash flow. Reliance Industry cash flow has lower risk, whereas the other Reliance, which Anil Ambani's company, their cash flow has higher risk. Reason is they are into distress, he is not into distress. So if I'm taking a loan at higher rate of interest, I need to discount the tax benefit at a higher rate of interest. Discount it at higher rate, because if you're taking it at higher rate of interest, unfortunately there is more risk in your company. Unfortunately, there is more risk in your company. And if you're taking at lower rate, there is less risk in your company, but it is pre-tax. It is pre-tax because pre-tax is what is prevailing in practical world. If I ask give me a loan, or I want to give you a loan, I'll charge you an interest. That interest is based on the risk, and based on the risk I'll tell you the interest which is the pre-tax. I cannot tell that give me post-tax 20%, give me post-tax 10%, give me post-tax 5%. So APV approach says do valuation of unlevered firm. What is unlevered firm? Company which does not have any debt. Company which does not have any debt, and get the tax benefits of debt. What is tax benefit of debt? If it's a perpetual debt means there is no end. Perpetual debt means there is no end. This is what Modigliani Miller said. Amount of debt into tax rate. If you remember, amount of debt into tax rate is what Modigliani Miller said in his approach. If it's redeemable debt, first year interest, tax saving, second year interest, tax saving, third year interest, tax saving, fourth year interest, tax saving, fifth year interest, tax saving, 6, 7, 8, 9, 10, and discount all of this at pre-tax cost of debt. Pre-tax cost of debt. Pre-tax cost of debt is used as a discount rate because the same is a proxy. The same is a proxy for risk of cash flows related to tax saving. You see something called as bankruptcy cost. I technically don't need it. I technically don't need it. I can give answer without this also. But ICI Material has used this word called bankruptcy cost. First, I'll explain without bankruptcy cost, how do I get the answer? Then I'll tell what ICI wants you to present called as bankruptcy cost. Why they want you to, why I don't know, but they want you to present this bankruptcy cost. It is a term which is used. Suddenly an MCQ comes and they ask what is the bankruptcy cost, you will get stuck. So I'll explain what is bankruptcy cost in some time. But without that itself, I can get my answer. Let's look at an example. Just give me a minute. Just 1 minute. Let's take this example. 150 crores, amount of debt 50 crores, 30%, liquidation value, probability of distress is given. Please ignore this for the time being. Can you tell me what is the value of the firm using going concern plus liquidation value approach? Going concern plus liquidation value approach. Going concern plus liquidation value approach. Going concern plus
120, sir.
Okay, so the answer is 150 into 60%, 75 into 40%. What's the answer you get? On top of that, tax benefit on debt is 50 into 30%, 135 crores is the answer. Directly I can do this. Directly I can just do the earlier approach and add tax benefit. Add tax benefit. ICA has given some formula. Unfortunately, I'll have to use that formula. Same answer only will come. Same answer will only come. But if at all they ask bankruptcy cost, what is bankruptcy cost? Is probable fall in value. Probable fall in value if suddenly bankruptcy happens. If suddenly bankruptcy happens. What is a normal firm value? Going concern is how much? 150. Liquidation 75. So probable fall in value 75 crores. Probable fall in value is 75 crore. What is the probability of a distress happening? 40%. So 75 into 40% is called bankruptcy cost. Again, I'm repeating, I don't even remember this bankruptcy cost because to explain you, I had to see this because I don't remember how bankruptcy cost is calculated. My logic is very clear in my mind. Going concern value into probability of survival, distress value into probability of distress, add the tax benefit. That is very clear, easy for me to understand. This example is slightly difficult for me to understand, but ICA Material has used the word bankruptcy cost and they have given a formula also. They have given a formula also. So I don't want you to miss out there. I don't want you to miss out there. Will the answer be different? No, answer is going to be same. So how they did this, you start with 150. You start with 150. In the 150, they are saying bankruptcy cost is 30 crore. Bankruptcy cost is 30. What is 30? 150 minus 75 into probability of distress. So 30 crore subtracted. 30 crore subtracted. What do you get? 120, which is what you told me. Which is what you told me. So either you do it this way or you do the other way around, you will get only 120. On top of that, add tax benefit. On top of that, add tax benefit, which will make it 135 crore. How to get tax benefit? Two approaches. Perpetual debt, amount of debt into tax rate. Redeemable debt, then every year please calculate the interest, calculate the tax saving and do discounting. I'll show problems on this in some time. Let's do this MCQ. Try this MCQ. Try this MCQ. In your mind you can do DCF, that going concern into this you can do, but in exam please calculate bankruptcy cost because it may come as one of the MCQ. It may come as one MCQ in exam. That's the reason I'm telling you to do it. My mind clearly says 100. What is the probability of success? 60%. So 100 into 60%. 40 into what is the probability of failure? 40%. So all put together is how much? 76. Tax benefit is 50 into 30%. That will give you the value of firm. That will give you the value of firm. What they've asked is value of equity. So subtract the debt quantum. Subtract the debt quantum. Okay. The last approach of valuation, which is what I see is the best approach and logical approaches, easy to discuss for me also, is relative valuation method. What is relative valuation method? Is nothing but we have already done. We did in one question capitalization by sales, capitalization by assets. So you can decide anything. But the only point is, if for a normal company capitalization by sales is 10 times, for this company it cannot be 10 times, it has to be 7, 6, 5. It has to be adjusted downwards. That multiple has to be adjusted downwards. That's the only difference for valuing a distressed company. In a normal company, in the last class we did that breakup value approach question where you had capitalization by sales or a capitalization by this. So in a normal company, you can use the multiple of the industry, 20, 25, 10, all that you can use. But when it comes to a distressed company, you will have to adjust this multiple downwards. How much to adjust? That's your wish. The question may indicate something. Otherwise, you can even leave it. But in a practical world, it is a judgment call. It is a judgment call saying that TCS is at a P multiple of 20 times. My company can be only at a P multiple of 4 times. P multiple, as such will not work because profits will not be there in most of the time. Profits will not be there. If profits are there also, you will have to adjust the multiple downwards. That is what the approach says. So relative valuation is not new. Relative valuation is something we have already done. We have already done. The only add on here is you have to adjust this downwards. You have to adjust this downwards to factor the risk of bankruptcy. Next part of the valuation, which is valuation of startup. Now, they are going to be fairly simple methods of valuation. The only problem with startup valuation, let me first discuss the problem. Traditionally, we have three approaches of valuation. One is cash flow or profits. Then second is assets. Third is based on relevant company, based on some other company. So I divided into four. Cash flow and profit is one part, asset is second part, and relative valuation is third part. Cash flow or profit does not work because startup is suffering losses. Asset method also does not work because most of their asset is intangible in nature. Swiggy's valuation, Amazon's valuation, you may not see physical assets much. Third, relative company also does not help because startup is going to be unique in nature. So that is where the problem comes. So a lot of subjective element is going to come. So the first approach I'll discuss is Berkus approach. What Berkus said is every company, if it wants to succeed, there are few critical success factor. So he decided the success factor and said, if your value is good, 20 lakh rupees for basic value. If your technology is good, 40 lakh rupees for technology. Some random value, there is no logic for that value. But if your basic value is good, 20 lakh rupees for basic value. If your technology is good, 20 lakh rupees for technology. If your execution is good, 40 lakh rupees for execution. If your strategic relationships are good, another 20 lakh for strategic relationship. If your production and consequent sales is good, another. So what this Berkus, when he came, he basically said each of this is $500,000. That is what he said. His approach was every item is valued $500,000. In that $500,000, you may decide to give.
Your voice is breaking.
Okay, others are facing an issue with the voice. Guys, can you confirm? Because the net is fine here.
Yes, sir.
Yes, sir.
Voice is breaking, sir.
Okay, take it. Let me check. Just give me. Okay, you guys can check from now onwards. If you face an issue, then let me know. Okay. So what he said is there are 5 factors. Each has a value of $500,000. So basic value in $500,000, you can give a value of 0.4, 0.3, 0.2, 0.1. That's your wish. Basic value is basically what value the startup is trying to bring. What is its technological strength? Most of the startup are dependent on the technology part. Execution is based on the team which it has. Strategic relationship is the customer side relationship and the supplier, and the last is the sales. Most of the startup could be at pre-sales. So he said if you are pre-sales, only first 4 factors are relevant. 2 million is your maximum value. And if you are started with the sales, then your maximum value is 2.5 million. This is what Berkus said. You can alter this the way you want. Now, how do I get an answer? You will see my problems are all fairly simple. I am given an example just to make you understand. Otherwise, then example is also not needed. Now listen. An investor is planning an investment in ABC Tech Limited, which has the following 5 factors. Basic value. ABC Tech is unique and it has an innovative business idea. Then technology. ABC Tech has developed a working prototype showcasing its functionality and capability. Execution. It has a highly skilled and experienced management team. Strategic relationship. All this, the first 5 lines which you see is of no use to solve the question. This is just giving you some broad overview as to what the company is doing. How are we going to do the value? Basic value is 0 to 20 lakh. Basic value is, the value can be 0, the value can be 20 lakh. On a scale of 0 to 10, it is 8. So maximum value, if you get a score of 10, I'll give you 20 lakh. If you get a score of 10, I'll give you 20 lakh. You got a score of how much? 20 lakh into 8 by 10. 20 lakh into 8 by 10. No major calculation and all. Okay. Technology 0 to 10 lakh is the range. 0 to 10 lakh is the range. How much score you got? 6. So 10 lakh into 6 by 10. 15 lakh into 8 by 10. 40 lakh into 9 by 10. 50 lakh into 4 by 10. This is my customized approach. What Berkus said, Everything is $500,000, 0 to 50 lakh, 0 to 50 lakh, 0 to 50, 0 to 50 millions. That is in dollars, okay, not in our calculation. 0 to 5 lakh dollars, sorry, 0 to 5 lakh dollars, 0 to 5 lakh, and you can keep giving a score. So the value is done. That's all. 90 lakh is the overall value. 90 lakh is the overall value. Nothing much tricky to be done here. I'm just saying put the cash flow, get the value, and sorry, put the variables. All this is subjective in nature. Everything is subjective in nature. Somebody may decide, no, not these five, I want to add another variable. Add it. Everything is subjective only. Everything is subjective. You can just know that this is the approach. This is the approach. Any doubts on this? Then came the second approach. This is the most useless approach of the startup valuation, which is cost to duplicate approach. Now, what is cost to duplicate approaches? They are saying, if I was to recreate the startup, how much cost I will incur? How much cost I will incur? Swiggy has been created. I know how the software has been created. If I was to recreate its app, recreate its technology, what cost I'm going to incur is called as the value of the startup. It's called the value of the startup. Now, this approach is often criticized for not focusing on the future revenue projections, because you are just saying, I'll just add the cost you have incurred until this is the value. This is the value, whereas the valuation cannot be based on that. Valuation is based on the future benefits. Valuation is based on the future. In this case, if you have wasted money, your value will be higher, because you have spent more. The value is more because you have wasted the money. Cost to duplicate approach involves taking into account all costs and expenses incurred with the startup and its product development, including the purchase of physical assets. All such expenses are considered to determine the value. I don't want to consider, I just want to consider debit side of P&L. Debit side of P&L, ignore the credit side of P&L. Ignore the credit side of P&L. Nothing much for me to explain here. Add up all the cost, the value is done. That's all. Add up all the cost, the value is done. So that's a very simple approach. Research and development cost of physical asset, intellectual property, employee salary, marketing and advertising. Add up everything. That's the cost of the startup. That's the approach set. That is what the approach said. Clear? Any doubts on this? Okay. Comes the third approach, which according to me is the most logical approach. Comparable transaction method. Only challenge is finding a comparable transaction. Finding a comparable transaction. Where I'll give you an example. This will be easy to understand. Monica is trying to value chat app, a chat messaging app that currently has 16 million user, but does not generate any revenue. She has identified WhatsApp, which was recently valued at what? USD 450 billion, while having 450 million users. Considering the difference in size, Monica believes that a size discount of 95% should be applied while valuing chat up. Now, what is this? Is relative company valuation. Relative company valuation. You look at what happened in the other company, what happened in the other transaction, get the comparable metric and adjust that metric upwards or downwards. Adjust the metric upwards or downwards. For example, here, WhatsApp has been valued at what? 450 billion is equal to 450 million users. 450 billion is equal to 450 million user. 1 billion is 1000 rupees. 1 billion is technically, sorry, 1 billion is 1000 million. 1 billion is 1000 million. So 450 billion is equal to 450 million. How many users our company has? So 16 million is equal to question mark. 16 million is equal to question mark, which is 16 billion. But then they are saying you adjust 95% downwards. You adjust this 95% downwards. So from 16 billion, if you adjust 95% downwards, 16 billion is 16,000 million. 16,000 million. If you deduct 95%, you will be left with 800 million. So this is not a new method. This is relative valuation method. This is relative valuation method. Clear? Any doubts on this? And this is among the methods the most logical one. But only challenge is you cannot use your traditional method like market cap to sales, because sales will not be there. Market cap to profit will not be there. So most of the items may not be there. So you'll have to identify what is relevant for them. So I want to value Bharadwaj Institute. It is making losses at this point of time. I can value it basically maybe calculating something called as value per student, and then try to arrive at, okay. Next comes the scorecard valuation method. Now, Berkus and scorecard valuation method is more or less interlinked. Only difference is in Berkus, I don't need any comparable company. In scorecard valuation method, I'll first take Bharadwaj Institute and then take some other company. Take some other company. Keep doing comparison of Bharadwaj with that company. I could be better than them. I could be weaker than them. In what metric? You can decide whatever you want to do. Normally, these are the metric. Strength of the team, size of the opportunity, product or service, competitive environment, marketing, sales channel, partnership, need for additional investment. Other, you can decide whatever you want to do, whichever method you want to adopt. So you decide the metric. Give a score for each metric. You could be better, you could be weaker. How to give score? Judgment call. It is a judgment call. The question will do all that. They'll give you the score saying that I have given this score, I have given this score. Once I decide to give score for everything, ultimately considering all factors, Bharadwaj could be better than the other company or weaker than the other company. For this, I'll have to show you an example. Let's look at an example. Whatever you see in the top is just a story, not needed. I'm not reading it basically. Now I'm saying, okay, okay, management team expertise 30% weightage. Okay, and I am above average than them. I am above average. I'm not reading the other part of the line. This is just for you to. I in fact copied it. I have taken it from ChatGPT. I've created the question. I've just did that. It gave the write up. I've just pasted here. I've not done anything here. This is weight is 25%, and I am at par. I am at par. This weight is 20%. I am below average. This weight is weight is 15% and I am below average. I am below average. Weight is 10%. I am below average. Now, ultimately, whether I am above average or below average as compared to the competitor. In few, I am above average. In few, I am below average. In the calculator, 0.3 into 1.2, 0.36. Keep it, note that number. Okay. First metric is 0.3 into 1.2. Second, 0.25 into 1, which is 0.25 as it is. Third metric, 0.2 into 0.8, 80%, which is 0.16, like you have fourth metric. Fifth metric, can you tell me weighted average, what is the score? 0.3 into 1.2, 0.25 into 1, 0.2 into 0.8, 0.15 into 0.6, 0.1 into 0.5. So I am below average as compared to the competitor. I am below average as compared to the competitor. What is the value of the competitor? 200 crores. My value is 0.91 of 200 crores. My value is 0.91 of 200 crores. Very simple. Some logic is there, some logic is not there in this. That is, arriving at the score is difficult. Arriving at the score is difficult. My competition is at 200 crores. I can be better than the competition. I can be weaker than the competition. Few metrics I am better. Few metrics I am weaker. So I arrived at a final score. I arrived at a final score. Any doubts on this? Can you proceed? Berkus as well as both are subjective. Difference in Berkus and this you need one comparable company. This you need one comparable company. In Berkus you don't need any comparable company. You only do your own estimation then keep putting. Berkus I told very clear. Every metric $500,000. Every metric is $500,000. Here you are taking a competition company and then doing the valuation. Clear? Any doubts on this? First Chicago method. Now it basically tells that I initially started with modified discounted cash flow approach when I initially started in distressed company valuation. Then I said what you need to do is you need to give me a best value. You need to give me a worst value. You need to give me a normal value and take a weighted average. Take a weighted average. This is what he said. The method combines a discounted cash flow approach and a market approach to give a fair estimate of startup value. He says find out the worst case. Find out.
Screen is still on the question.
Sorry.
Screen is still on the question.
Which question you want me to explain? Sorry.
No, sir. The screen is lagging.
The screen is lagging. Are others facing an issue?
No, sir.
Okay, then it's an issue at your end. So discounted cash flow approach. So you need to get three value. Now the trouble is a startup valuation itself is very difficult. So how do I get a worst case value? How do I get a normal case value? How do I get a best case value? Assuming question gives you all the three. How that value could have been arrived? Using some of the other approaches. Using some of the other approaches, it only says once you get the three number, do weighted average. Do weighted average, nothing beyond that. It is nothing beyond that. This is what I will do even in a normal company. Even in a normal company, we did normal company valuation. There also you can get three different answer and do a weighted average. Do a weighted average. Okay, last comes the venture capital method. I think practically this is what is done mostly. What venture capital method says is it's impossible for me to do a startup valuation today. Impossible for me to do a valuation today. So I will value the startup 10 years later or 20 years later or 15 years later or 5 years later. Basically my exit value. I'll decide what should be my exit value. That is after 5 years, I want to exit from the startup with 200 crores. I want to exit from the startup with 200 crores. Once you have arrived at the value of exit, you keep discounting that and get today's value. You keep discounting that and get today's value, because today nothing is there. There is no revenue, there is no profit, there is no technology, nothing is there. So let's not get into today itself. Try to estimate what is the exit you want. What is the exit you want? After the exit is decided, keep discounting it. Keep discounting it to arrive at today's value. Keep discounting it to arrive at today's value. This approach is commonly used by early stage investors and involving estimating the startup's future value. Startup's future value at the point of an exit. How can an exit happen? This startup can get acquired by another startup, or an IPO can happen. I'm not sure how many of you have seen the show called Shark Tank. There they'll keep talking about how will I get an exit? How will I get an exit? So they keep estimating that how is the exit going to happen for the investor, how the exit is going to happen for them. So they will keep that in mind, and based on that they'll do today's investment. The valuation is based on the expected rate of return. For example, I can say I want a 10x return on investment within 5 years. So I'll exit at 100 crores. Today I will do 10x means 10 crore I'll give today. 10 crore I'll give today. That would estimate the startup value at the time of exit. This value is discounted at investors' expected or required rate of return. Now the question which you see is a CFA exam question. It's a CFA exam question. They have excellent questions in their material on this area on startup. So I'll discuss the question. Very good problem. ICA may test, may not test, but let's discuss it now. But the concept is very simple. I am trying to estimate what will be my exit value. What will be my exit value, and then I come to today's value. Then I come to today's value. Founders of small technology firm are seeking a 3 million venture capital investment from prospective investor. The founders project that the firm could be sold for 25 million in 4 years. It could be sold for 25 million in 4 years. The private equity investor says, I need to apply a discount rate of 25%. So the cost of equity is 25. But believe that there is a chance of failure in any year. There's a belief that it can fail, 20% chance that it can fail in any year. You told me that after 4 years, you will get 25 million. First year got over, company itself is not there because there's a 20% chance of it failing. So what is the probability of succeeding in the first year? 80%. Okay, wait. Then in the second year, again it can fail. Again, it can fail. What is the probability of that happening? 20. So probability of success again is 80. If you have to succeed in both the years, it is only 64% chance. This is called, when you toss a coin, first probability is 0.5. Second toss also you want 0.5, joint probability, 0.5 into 0.5. Third toss also you want a head into another 0.5. So first year success 80%. Second year also success is 80%. Third year success is 80%. Fourth year success is, it has to withstand all this. It has to withstand. What is the probability of all this? Multiply 80 into 80 into 80. How much? No, probability. Tell me the probability. 80% into 80% into 80% into 80%. 40.96%. So what happens is, if you invest, there's a probability that 40.96 probability you will get 25 million, and balance you will get 0 million. Balance probability is 0 million, because you can fail at any time. You can fail at any time. So what is the value of the startup? 25 million into 0.4096 plus 0 into 1 minus 0.4096. Let's not worry about the 0 part of it. Let's not worry about the 0 part of it. 25 into 0.4096. We'll solve a problem later on. Let me first discuss the MCQ, then I'll solve the problem. So 10.24 million is the value in when? Year 4. See, what can be the value in year 4? It can be 25, it can be 0. Probability says it can be 10.24. Discount that to today. Discount that to today. At what rate? 25%. After discounting, you get something called as post money valuation. What is post money valuation? Is whatever value you got will come only if I give this 3 million. Will come only if I give this 3 million. If I don't give 3 million, startup itself will not exist. If I don't give this 3 million, startup will try for money from somewhere else. So whatever value you got is including this 3 million. Is including this 3 million. So what is pre-money? Exclude this 3 million. If at all you have seen that show, they would talk about this pre-money, post-money valuation and all. Those are the terms they'll use. But netted, very simple. If you give this 3 million, value is 4.19. If I don't give, value is 1.19. Value is 1.19. We'll do problems on this in some time. Then read this. Read this. Okay, you will do it together. Okay. How much investment we want? 5 million. Okay. I expect that in 4 years, I am going to take an exit and I have 3 possible equal means simple average you can do. Simple average. Now write value on exit equal to if first scenario happens, what is the value? 20 into 10 times. 20 into 10 times. Second scenario happens and third scenario happens, divide by 3. 80.67, that is the value on exit. That's the value on exit. Now this 80.67 has to be discounted by what? 25%. So in the calculator, 80.67 divide by 1.25 for the first year, second year, third year, fourth year. Divide 1.25 4 times. That is discounting. You can even do into discount factor. 80.67 divide by 1.25 power 4. What number you get? 33 point. This is post money. This is post money. Pre money is subtract this 5 million of yours. Subtract this 5 million of yours. So you are left with 28.04. You are left with 28.04. Excellent question. All these are CFA exam questions. All these are CFA exam question. Go through the next scenario. Keep going through this. I have one more example. Okay, some companies facing some problem. So a private equity firm is coming into picture. They're saying I'll get the 80% of the residual value and 20% can go to management. Initial investment is 500 crores. In this 350 crores will come from debt. 350 crores will come from debt. 150 crores will come from equity. 150 crores will come from equity. 70% debt, 30% equity. The equity component is 120 crore of preference. So preference is part of equity for all practical purpose. Internationally, that is the norm. In our exam questions, unnecessarily they bring in preference and they complicate things. But practically, preference is mostly contributed by the owners of the company, and it will be convertible preference, which can be converted into equity at any point of time. So 120 crore of preference, 25 crore of private equity firm equity, and 5 crore of management. In that 150 crores, there are three things happening. 125 crore is for, so 120, yeah, 120 crore is preference, 25 crore is equity, and 5 crore is management. Now expectation is this 500, if I invest on exit, it will become double of this. On exit, it will become double of this. Projected multiple is 2. Projected multiple is 2. In this 1000, you have to first pay the debt guys, pay the preference guys. How much you have to pay the debt guys? How much you have to pay the preference guys? 300. So leftover value is leftover value is 550. Whatever is leftover, the first line says 80% will go to the private equity guy and 20% will go to the management. So what management is doing is, in that 550, they'll get 110 crore. They'll get 110 crore. They invested 5 crores and they are going to get 110 crores. So they are getting 22 times return. They're getting 22 times return. Management invested only 5 crores. Invested only 5 crores. On exit, they are getting 110 crores. How 110? 80% will go to private equity. Residual means after meeting your debt guys, preference guys, all that. Leftover value. Why preference is also paid? Because they have said I'm giving around 300 crores to the preference guy. I'm giving 300 crores to the preference guy. So leftover value, equity comes, management gets and private equity gets. Okay, in fact, better let's do the numbers. Let's do the number rather than discussing it. Put 500 crores first. There are too many numbers, so let me put the numbers. 500 crore. 500 is the initial contribution. In this initial contribution, 350 is debt, 150 is, in this 150, 145 comes from P and 5 crore comes from management. What is 145? He is bringing preference as well as equity. 145 is the contribution by the private equity partner. 5 crore is the contribution by the management. During exit, this 500 will become what? In this 1000, I'll first pay the debt guys, then pay the preference guys. How much you have to pay debt? Which means I've already paid some 200 crores of debt. Only 150 is pending. Leftover is 850. How much you have to pay preference? Leftover. In this 550, private equity, management. How much private equity will get? Which is 440. How much management is getting? 110. So now listen, net end conclusion is private equity will get this 300 as well as this 440. Private equity will get this 300 because preference is contributed by him. So he will be getting 740 crore on investment of 145. He'll be getting 740 crore on investment of 145, and this way I will get 110 on investment of 5. So that the division, can you divide and tell me 740 by 145 so much? 5.10 and 22. 5.10 and 22. Apart from this, ICI in their material has talked about valuation of digital platforms I've not covered in the concept book, but there's no separate approach. Digital platform means an example, any payment gateway you can take a payment gateway, or you can even take an Amazon as an example. So for digital platform calculation, what they are saying is you will have to forecast the cash flow and do discounting of the cash flow. The approach does not change much. Just give me a minute. Explain the approach for valuation of digital platforms. So digital platform, they're saying you can either do it through income approach. Income approaches estimate the income of it. When you are doing the estimation of the income, they're talking about certain approaches which are good from a practical point of view. There's something called as a top-down approach and a bottom-up approach. What is top-down approaches? First estimate what is the overall market, and then keep coming downwards and tell how much sales you are going to do. Bottom up approach is how much resources you have. Based on that, you estimate what will be the revenue. These are just terms to explain you what can be the potential revenues of the company. Once you have decided the revenues, you keep doing the discounting and then close it. You keep doing the discounting and then close it. Market approach is relative company. Market approach is relative company. Take a multiple like EV by EBITDA, price earning multiple, price to book value approach, price to revenue approach, price to sales approach. Cost approaches, as I said in that startup approach, cost to duplicate, keep adding the cost and then tell the value. So there's nothing different as such, but I've covered 2-3 questions in the material, but it is just talking about general theory. Then they have talked about professional or consultancy firm. What is professional or consultancy firm? Example here, chartered accountancy firms. There they have given some general information. They're saying that you do all valuation, but in a firm like this, most important factor is KPI, key performance indicator, key performance indicator. So on the KPI side, you could be doing better than the industry, or you could be doing weaker than the industry. If you are better than the industry, you get a higher value. If you are weaker than the industry, you get a lower value. Some KPI adjustment may have to be done. And last is impact of ESG on valuation. This is an evolving area. Practically, lot of companies or lot of investors want to invest in companies which are ESG compliant. I would discuss this in detail when you see my theory video. But what is ESG compliant company? Something which takes care of environment, social as well as governance. In SCMP, you will learn something called as triple bottom line framework, where you have to focus on people, planet and profit. Similarly, here they are saying you have to focus on economy, environment, social and governance. What the question says is, or what the concept is saying is, if you are a ESG compliant company, then your cost of capital can be on the lower side. Your cost of capital can be on the lower side because people are ready to give you loan at even a lower rate. So based on this ESG part, either cash flows can change or the discount rates can change, and accordingly the valuation can get impacted. Just to give sudden quick example, I'm not going to do it, but this is income approach of valuation. This is, I'm talking about all the digital platform where I have given certain basic information that how many people are, how many sellers are there, what is the transaction value. You keep estimating. This is bottom up approach. You keep estimating, get the income. Once you get the income, do discounting of that and get the value. Do discounting of that and get the value. What is market approach? Relative valuation. Example, Google and competitor. You have the valuation of the competitor. Now you'll have to arrive at the value of our company, which is Google. And they are saying capitalization per user. What is capitalization per user? 1000 crores is the value. 1000 crores is the value and 5 crores is the number of user. 5 crore is the number of user. So 200 rupee per user is the value. 200 rupee per user is the value. They are saying this should be adjusted by 20% for relevant search result and time taken per search. What is relevant search result is Google could be better than the competitor. Google could be weaker than the competitor. Time taken per search, Google could be better. Google could be weaker. Relevant search 9 out of 10 and he is 8 out of 10. I am better. I need higher value. I am better. I need higher value. Time taken per search, I am getting it faster. So again, I am better. So give me a better valuation. So that multiple price to book value can be adjusted upwards, can be adjusted downwards. So you see this question, you will understand it. Valuation of professional or consultancy company. I tell you to do the valuation. After the valuation is done, we are saying KPI. I will do adjustment based on KPI. If you are doing good on the KPI side, more value. If you are doing bad on the
Sir,
KPI
your
side,
voice is not audible.
guys, others are facing an issue.
Sir, you are not audible.
Sorry. Okay, I assume it is fine. So if you are good on the KPI side or bad on the KPI side, there are only two things. Just let's look at an
Sir,
example.
your voice was not audible.
Guys, are you facing an issue?
Yes, sir.
Okay, just give me a minute.
Just for the past 5.
Okay, it should be better now. So my performance could be better than the competitor, or my performance could be weaker than the competitor. These examples are just to explain that concept. For example, my retention is at 90%, industry is at 80%. I am better, I need a higher value. I am better, I need a higher value. New client acquisition rate, I am acquiring 15% new client. Industry is at 20%. I am at bad. I am at a bad KPI. Utilization rate, that is how much time I'm able to utilize. Industry utilizes 80% time. I'm utilizing only 75% time, which is bad. So you could be good or bad on a KPI, and accordingly adjustments will have to be done. You see all these examples, you will understand nothing much is there. And last is ESG impact, where you can have impact based on economic environment factor or social factor or governance factor. Some of the examples, if you read them, you will understand it, and accordingly impact has to be done on the cash flow. These are self-explanatory items. I don't have much to explain here. Only reason for giving this is to better appreciate the concept, that's all. Otherwise you may not get much learning out of it. When you do the calculation, you will find that no major learning is there. It is just given for the purpose to better appreciate the concept. I'll quickly revise what we have done in valuation. Okay, we started with economic value added. EVA is the excess return generated. EVA is the excess return generated. So EVA is technically equal to EBIT into 1 minus tax rate minus invested capital into WACC. Invested capital has to be economic value or the real value of the asset. Invested capital is economic value or the real value of the asset. EBIT will have to be adjusted upwards or downwards for certain items like advertising, training, tax expense, non-cash expenses, accounting depreciation, economic depreciation. When you do your WACC calculation, this is a format: source, cost, weight, and product. Be cautious about debt by assets and debt by equity ratio. Operating income is EBIT, net income is profit after tax. EVA dividend is the excess return generated. So you can pay EVA dividend per share. If you pay, no problem. If you don't pay, value of the firm will increase. EBIT, financial leverage is EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. Using this, you can calculate EBIT and then proceed ahead. Tax adjustment on EVA computation, there are three ways of doing it. EBIT into 1 minus tax rate, easiest and best approach, provided no non-cash item, all that is there. Second approach is PAT plus after tax interest. That is the next best approach. And the third approach is you start with EBIT, deduct cash taxes, and deduct something called as tax saving lost on interest. P multiple can be adjusted based on your operating risk and financial risk. Financial risk is measured through debt to equity. High debt, high risk, low P multiple. Low debt, low risk, high P multiple. Valuation form on the base of EVA, very simple. Whatever value you are getting today, that is invested capital, add present value future EVA, that is the extra valuation. Market value added is equal to market value of firm minus the book value of firm, where market value of firm is market value of equity, market value of debt, market value of preference. Debt and preference is same as book value if problem is silent. Cash flow based, you have FCFF and you have FCFE. FCFF discounted at cost of capital, FCFE discounted at cost of equity. Cost of capital, if you discount, you get value of firm. Cost of equity, if you discount, you get value of equity. From value of firm, if you deduct value of debt, you will get value of equity. Both should be same. Important principle is cash flow between the owner and the company is to be ignored. So when you do FCFF approach, you equity dividend is ignored in both. Equity dividend is ignored in both. Buyback of shares is ignored in both. New shares issued is ignored in both. But interest paid ignored in FCFF, considered in FCFE. New loans taken, ignored in FCFF, considered in FCFE. Gross capex. What is gross capex? Is what you show as addition in your fixed asset schedule. What is net capex? Is net increase in fixed assets. You can either deduct net capex or add back depreciation and deduct gross capex. Working capital is increase in working capital or decrease in working capital. Increases outflow, decreases inflow. Be cautious when there is a change in growth rate. Relative approach of valuation. We discussed this in multiple places. Doing valuation based on proxy company, which can be adjusted upwards, downwards if you want. Breakup value, breaking the company into multiple segments, valuing each of the business using an appropriate approach. Future maintainable profit approach. You start with your today's profit. Adjust extraordinary item upwards, downwards, new product business, future maintainable PBT, future maintainable PAT, divide by the capitalization rate, you get the value of business. You can start with future maintainable PAT, deduct preference dividend, future maintainable EAES, number of equity share, EPS, P multiple and MPS. Net assets method is realizable value of assets or fair value of assets minus value of liability divided by the number of shares. And earnings capitalization is FMP divided by the capitalization rate and get the number of shares. All this will give you value of firm. Sometimes it can give you value of equity. Sorry, earnings capitalization will give you value of firm. Deduct the value of debt. Net assets method, value of debt would have been subtracted earlier itself. Net cash flow approaches, residual net cash flow divided by the cost of equity. Book value approaches, share capital plus reserves and surplus minus the fictitious asset. And minimum price is lower of the two. Maximum price is post-merger price minus the pre-merger price divided by the number of shares issued. And your floor value is the current market price. Internal reconstruction, item increasing, item decreasing, get the capital reserve and then prepare a balance sheet. Wrong WACC, start with wrong value, wrong growth rate, wrong value and wrong WACC, get the wrong weights, then get the correct weights, get the correct WACC, get the correct value. Per share earning value, I'm not discussing it. Initial outflow on acquisition is what you are giving to every item of your liability. What you give to equity guy, what you give to debt guy, what you give to preference guy, what you give to your external liability, what you incur extra, minus what you realize. You may realize everything other than fixed asset. You may realize even fixed asset also if you want. Whatever the company wants to do, deduct all of that, you will get your initial outflow. Year cash flow, PV of DCF, initial outflow is there, in between flow is there, terminal flow, positive NPV, negative NPV. Funding required for growth. If business grows up, there will be a need for extra funding. What is extra funding? Is increase in capital employed. What is capital employed? Is fixed asset plus current asset minus current liability. It can come from debt. It can come from short-term debt. It can come from long-term debt. It can come from retained earnings. It can come from equity. It can come from preference. Intrinsic value of equity is nothing but whatever is the value of firm you got. Subtract the value of debt and add non-core assets. Add non-core asset. Distressed company, we had 4 methods of valuation. First is modified discounted cash flow approach, where get the cash flow, do 3 valuation, do weighted average. Not possible, get the cash flows, deduct probability of default, and then do the valuation. Second is weighted average of liquidation value into probability of distress and going concern value into probability of success. APV approach is same as this, but add an element called as tax benefit. Perpetual debt, tax benefit is equal to amount of debt into tax rate. Not a perpetual debt, every year get the cash flow, every year get the tax saving, every year do discounting at pre-tax cost of debt and get the value. Now, when you do your adjusted present value approach, you'll have to calculate bankruptcy cost. What is bankruptcy cost? Is normal value minus the liquidation value into probability of failure. What is the final value? Normal value minus the bankruptcy cost, add the tax saving. Next is relative valuation. I've already discussed. Only thing is the valuation has to be revised downwards. Berkus approach, 5 metric, each is valued 500,000, give score and do the valuation. Cost to duplicate, add all expenses, get a value. Comparable transaction is same as relative valuation. The multiple can be adjusted upwards, can be adjusted downwards. Scorecard valuation, bring a proxy company, put score on each of this, above average, below average, above average, below average, get a weighted average score and multiply it with its valuation. First Chicago method, get me 3 different answers, worst case, best case and normal case, and do a weighted average. Do a weighted average with the probability. Venture capital method says first find out your exit value. Once you find out your exit value, then discount that to today value. When you find out your exit value, there can be a probability of success, there can be a probability of failure. So exit into probability of success plus 0 into probability of failure, or technically no, nothing extra. You get a value, discount that to today's, that is called post money value. That is called post money value. In that, deduct what you are giving, that is called pre money value. Clear? Any doubts on this? Okay, let's take a break. I may resume at 2:30 mostly. I'll update. I mostly 2:30 is when we'll resume.